We'll get started in just a second, everybody. Happy Saturday. Happy 2025. Get rock and rolling here in just a minute. Let me enable the chat roll so you guys can comment, ask questions. How is my audio this morning? Good morning. Good morning, Brian, Denisa, Jim, Lewis, Sander, SK. Good to see you all. Get some familiar names. We get a bunch of new people expect to be on here tonight, or today, I should have said the recorded, so we'll give everybody a couple more minutes before we actually go live and get rocking and rolling. Good morning, Brian. If just one thing, when you're typing in questions here or commenting, if you wanted to go to the whole group, make sure it goes to everybody. If it just wanted to go to me, just say to hosts and panelists. One big thing there. So as we get the live stream going here, also we are live streaming this on YouTube. So if you guys step away or could run an errand, you can pull it up on your YouTube on your phone and watch. You can also on your smart TV stream me live this morning straight from your house. Hey, Denisa. Hey, Hoyt. Lewis. Good to see you all there this morning. We're probably going to have around 50 people on the training this morning, so it should be a good class, lots of good questions. We'll run from roughly 10 to roughly right about 1:30. Probably don't want to be longer than that. I know that the mic can only absorb what the butt can withstand. We'll take a couple short little breaks throughout, just so you know, just so you can get up, grab a fresh cup of coffee, take a bio break, and come on right back. I know your time's valuable, but we'll be done about 1 o'clock my time, and I'm in Austin, Texas. So just to give you a bit of an idea of what to expect. Hey, good morning, Stephanie. Good morning, Tiffany. Good to see you all this morning as we get rock and roll here on the Note Weekend Training class. All right. If you can, make sure you stick around till the end. We've got a very special offer for you guys. I'm just going to tell you right now on our upcoming class in 2 weeks. So stick around for that. Monitor your text messages as well, because we'll be sending it out to you as well if you guys step away. So just so you know, good morning from Cali. Tiffany says, good morning. Yeah, if you guys will do that, let me know where you're at, where you're joining me from. Type that in the chat room. I see it, but it's always good for everybody else to understand. And we have people from the East Coast, and we got Tiffany from the West Coast. What part of California? People from up north, like Minnesota. I think we'll even have a few people from Canada join us, maybe a person or two from Mexico. And we'll probably even have somebody join us from Australia as well, if they're still up. Lewis says, good morning from Augusta. Stephanie Hall from Ohio. What part of Ohio, Stephanie? Let's do this. Let's do this. Okay, record. There we go to the cloud. All right. Well, good morning, everybody. Welcome to Note Weekend here. It is happy 2025. This is the first Note Weekend of the year. We're pretty good last year about doing about 7-8 times last year in 2024. My goal is to do it about 6 to 7 times. So once every other month live, we'll restream this on the off months just so people can jump in and join in. And we'll be live streaming this to YouTube as well. So if you're joining us on YouTube, give me a shout out, give me a thumbs up. If you're watching the replay there, let me know where you're joining from. It's always good to see people from all across the country. And it's why I'm very passionate about teaching this virtually via Zoom, via online workshops, and things like that for you. So you have the opportunity, no matter where you're at, to buy notes wherever you want to in the United States. That's completely up to you. There's a few spots I like and a few spots I dislike. Or not favorable, I guess you could say the better thing of. I like those areas, but maybe I just don't like to buy notes in those. But anyway, glad to have you here. This is like I said, I've scheduled this from basically today, from now until about 2 o'clock. It's probably gonna be closer to 3.5 hours. We'll probably wrap around 1:30 for you, depending on the questions. And I'll tell you right now, there's no dumb questions. All right. I just ask that you, when you ask a question, make sure it is relevant for the topic that we are on. There's plenty of time for you to ask questions that are not associated with the slides that we're going through. But if you keep asking me questions from oddball stuff, it's going to be a lot longer than the 3.5 hours for you. And this class, by all means, is not designed to teach you everything about note investing. You're not going to learn everything about notes in just 3 hours. This is to give you a quick overview kind of what we teach in our 3-day, in our coaching, our one-on-one, but also how you can capitalize on what's going on in the market right now to see if note investing is a good thing for you, if it's something that you want to dive into. Look, note investing is not rocket science. I'm going to tell you that right now. It's a pretty simple once you figure out the concepts, all right? It's different from fix and flipping. It's different from being a landlord. It's different from wholesaling, okay? I've been a huge advocate of note investing once I started doing this back in 2007 when I bought my first note, okay? I'll go into a little bit of my background in a second, but no matter where you're at, I want you to approach this as that oh, I'm not good enough, I'm not smart enough, doggone it, banks won't sell me notes. Banks will sell you notes. Lenders will sell you notes. There's plenty of opportunity out there. And that's my whole goal with this, is so that you understand, hey, if this Dink from Ingleside, Texas can do it, you can do this. All right. You can do it. All right. You can do it again and again and again for your own portfolio, or using your own money, or using other people's money. Okay. Now, there are some things that I'll talk throughout this I might be a little biased about because I've seen people do different things. I've accomplished amazing things being a note investor the last 20 years, and you can do the same thing too as well out here. All right. So let's have a good time. No dumb questions, plenty of resources for you. I've had people tell me they learn more in this 3-hour class than they've learned in other people's 3-4 day workshops when it comes to note investing. I'm not a smoke blower. I am not a fan of blowing smoke. I will tell you how it is, what it is, the truths, the myths, the good, the bad, and the ugly when it comes to note investing. But anyway, ladies and gentlemen, welcome to Note Weekend Training. We're very proud of this. We started teaching this little mini class back in February of 2021, I believe it was. And so it's an anniversary of either 3 or 4 years of us teaching this class. And it's been a very beneficial part, I think, for a lot of folks of dipping their toes in the water to see, hey, if they like how I teach, but also if they like the concept. And we're very proud of the fact that we are the #1. That's right. We Close Notes is the #1 investor recommended training for note investing, especially when it comes to buying non-performing notes. I want to tell you what I'm not going to talk about today. I'm not going to talk about originating notes. I'm not going to talk about buying an owner finance. Yes, you can do that. We will not go into that. And I'll tell you my reasons for that in a little bit. I think buying direct from banks, buying from asset managers at REITs and stuff like that, it's much more efficient. It's a much smarter process. It's a cleaner process. It leads to higher returns, better property, better notes, and a continuous flow of deal flow that you just don't get that if you're chasing owner finances. No, I'm not going to talk about structuring a partial. Partials are great for small balances. You're not going to buy a partial note from a bank. I'll tell you that right now. Okay. I'm going to tell you exactly how it is and why I think this is the best way to invest in real estate compared to the fastest. And yes, there's plenty of inventory out there. There's plenty of deals. We are still seeing stuff 6 to 12 months ahead of most people out there, with all the headaches of toilets, tents, trash outs, and termites, without the banging your head against the wall, dealing with subcontracts, just flipping property, dealing with all that stuff. No. We are here to create a smart way. If you want to be passive, you can invest passively. If you want to be active, you can be active in this and make even higher returns when it comes to. We're not talking about doing skinny deals. Unless you want to do a skinny deal, no one ever said. Okay? We want to talk about doing good deals and have the opportunity to be able to take your business, take your life to the next level. And as we dive into kicking off this first session here, before I dive into the nuts and bolts of stuff, let me share with you some free resources. So first of all, welcome here. Ask your questions, but stay on point in the chat roll, in the Q&A part of it. If you're watching on the live stream, I will monitor the live stream from time to time, but most of it's going to be here on Zoom. If you're watching on YouTube, go on over and join us at weclosenotes.com, the Note Weekend, or go to noteweekend.com and register and be at that. All sessions are recorded. Yes, we record each session, so you can go back and watch these if you've got a bug out before the end of the day. I'm pretty good about chopping these up into 14, 15 smaller videos for you, so you don't have to go watch the whole thing. You can dive in directly to the session that you miss and go from there. Respect your fellow investors. All right, the golden rule: treat people as you would like to be treated. Okay, if somebody says something or has an opinion, that's completely they're fine. I'm not going to bash you for having an opinion. It may be incorrect if you don't have any experience, but I'm not going to I'm still going to respect you, because everybody comes from different aspects. Whether you're a seasoned real estate investor or you're just getting started, we welcome you all. Okay, and we encourage you to network with us and others that are here. In a little bit before one of the breaks, I'm going to ask you to go in and pull up your LinkedIn profile. or your contact information and put that into the chat roll so that other folks that are here on the class can connect with you. Yesterday, I posted a message on my LinkedIn profile. Hey, connect with me. I've got 30,000 connections plus on LinkedIn. Go connect me. Tell me what you're doing and use my network to grow your network as well for you. Okay. Now, we encourage you to ask Q&A. No dumb questions. We do have the Note Nation Facebook group that you can check it out and join. It's free. About 1,000 followers via LinkedIn. And if we got some time at the end of the day, we'll actually open up for end-of-day networking. Okay. Other resources for you. We have our, like I said, Facebook group. We do Note Night in America webinars on Monday night. We do one of them live at least once or twice a month. The others are going to be pre-recorded, and so not depending on what's going on. Our number one YouTube channel, WeCloseNotes.tv, is the largest YouTube channel for note investors out there with more videos, more subscribers, more content than anybody else. All right. Alicia, you can leave your LinkedIn till I tell you later. Okay. And also, if you're going to post a link in the chat roll with your profile, make sure it's an HTTP link, not just the www dot. It won't be. If you do HTTP, it's clickable for everybody. It makes it a whole lot easier. We have, like I said, YouTube channel, WeCloseNotes.tv, tons of longer videos, short videos, podcast episodes, all there for you. But most importantly, you might want to write this down. talkwithscottcarson.com. That's your link to join my calendar and book a call with me. All right, book a 30-minute phone call. I encourage each of you, especially if you're brand new to this, to book a call with me. Sometime next week, sometime in the next 2 weeks, book a phone call if you're trying to figure out where you want to go and you're new to note investing. I'd love to chat with you. Okay, love to visit with you and help you on your way. Some of the next steps after this class is to sign up for our note buying workshop. We have one actually in 2 weeks here in Austin, Texas, a live in-person workshop. You can go to notebuyingfordummies.com. There is a discount code. There's a bigger discount code if you hang around till the end for you guys on here as well. We have a monthly membership too that you guys can sign up for at $97 a month at Note Umbrella. We'll talk briefly about that later on. Of course, we have one-on-one mentoring. I'm here to help you guys take your businesses to the next level and go from there. But before we dive in, I always like to ask, what do you want to accomplish? All right. What is your why? Why are you here on a Saturday morning or a Sunday morning or whenever you're watching this? What are you here for? And I'd love to see you guys type that in the chat room. You know, we've got people from all across the country, East Coast, West Coast, North, South, Cleveland, Ohio, Modesto, California, South Florida, Miami, Austin, Texas. All right. So many people join us from all across the country, but tell me, why are you here? This is your opportunity to type it in the chat room. What's one thing that you want to accomplish or thinking about with notes? Is it to basically, you know, there's a variety of things. There's no wrong answers. Are you looking for cash flow? Hopefully all you are looking for cash flow. Cash flow is king right now. You have to create cash flow. Too many investors out there have bought properties for the equity and negative zero to little cash flow, and now they're hurting. Look at the multifamily syndication space. Completely hurting because there's no cash flow in a lot of those things, okay? Elisa wants to learn how to successfully buy notes. Okay. Lewis wants to create a steady stream of cash flow. Good stuff. But why? Why do you want to create that stuff for? What's the ultimate purpose on that? Are we looking for assets to add to our portfolio? Are we looking to boost income or retirement in some sort of fashion? Do we want to retire our spouse? Do we want to retire our parents? Do we want to put our kids through college? Are you just tired of being tired in the rat race? Do you not like your job? Do you want to do something different, become a full-time investor? Or maybe you're happy with what you're doing. That's completely fine. And you've got some money sitting in an IRA or on the sideline that you want to put to work to earn above average as a hobby. That's totally fine too. Whatever your why is, we can help. And I know some people say, oh, that sounds blank. I said, no, but we can. We can show you how to create cash flow and buying either performing or non-performing notes to get back on track. We can talk to you about taking assets back, depending on where you're living. Okay. We can talk about putting an extra 500 or 5,000 or 10,000 in monthly cash flow into your bank account by doing this as a passive investor or a part-time investor. If you're tired of being a fix and flipper or being a landlord, we can show you also how to transition those like we have with others in the past. We'll give you some case studies. Okay. And if you're just sitting on the sidelines, you got an IRA, a 401k, you got a little bit of money on the side that you want to put to work, we can help you do that as well too. We can help you find a deal or two to make your IRA earn an above average return. We'll talk about a deal. We just released a new podcast episode yesterday. Was it yesterday or the day before? I think it was actually Thursday. Now I think about it. about one of our most recent coaching students who closed on his first note in his first 90 days, making a 28% plus ROI in his self-directed, get this roll, Roth IRA. It's going to be completely tax-free growth on that deal for the next 5 years and beyond. He'll make 28% or more in his first 5 years. If the borrower keeps paying after 5 years, it will drop down to 22 because it's a BK, chapter 13, but it's a great, phenomenal deal. We'll talk about it briefly. All right, who else is sitting on here? Okay, Jim, thank you. Hoyt says, I want to scale up my real estate investment and make real estate investing easier than being a landlord deal intense. Yeah, nobody likes that. Boost income and get out of the rat race, Lewis says. Awesome. Thank you for sharing, everybody. Good. Good. Boost income, boost both income and retirement, Alicia. Good stuff. Thank you, guys. Love it. Love it that you guys are commenting on there. It always makes it easier when I ask questions and you guys respond. It's a beautiful thing. But anyway, so all right. So let's dive into the different types of notes, the things to look at. Okay. That's one of the most important things we do. And before I do that, let me make sure and do this one little bit thing. Boom. All right. Types of notes. There are a variety of different notes that you can target. Now, when you're starting off, I wouldn't say you're going to get targeting a 200 or 300 unit apartment complex. Just not going to happen right off the bat. You got to learn how to crawl before you walk and then learn how to walk before you run. That's not saying it can't happen. All right. Especially if you've got some experience in it. Yes, it can, but you've got to approach it from a different mindset than, oh, I'm gonna go buy the asset. That's the wrong thing. You're not buying the asset when you're buying the note. You're buying the note, the mortgage. Okay. But first of all, things that you're gonna be looking at is there's institutional and non-institutional debt. Okay. These are things that you will be looking at. And by institutional, we mean it's a mortgage note originated by a lending institution, a bank, a REIT, something like that. Non-institutional debt, I consider that debt that's been originated by a non-institution. Okay, duh. Owner finance notes. Maybe it's a contract for deed by an investor. There's a big difference in buying institutional versus non-institutional debt. Okay, buying owner finance notes versus buying bank notes. Okay, I think buying bank notes is actually easier because you have a lot of stuff. It takes a little bit of marketing, get into it, but you all can be looking at notes today and tomorrow on different stuff available and start marketing if you know how to do it. So you're going to be looking at residential first liens that are also, you can buy performing, you can buy first liens that are non-performing, you can buy second liens, junior liens that are performing and non-performing. I don't buy seconds. All right. Seconds right now are way overpriced because of all the equity. I'm still buying first at significant discounts. It's easier to raise capital for buying first liens than it is second liens. Okay. I just don't buy seconds because there's not that many out there like there is firsts. Okay. You can also buy commercial notes. Yes, commercial property notes. I actually started off buying commercial notes back in the day more so than residential. You can buy commercial that's performing, reperforming, or non-performing. Okay. Performing means when the borrower is paying on time. Non-performing means they haven't paid in at least 90 days. Okay. Reperforming is the borrower was once non-performing for a period of time, 6 to 12 months or whatever, and now has gotten back on track and is starting to pay on time again. Now, they're paying monthly. They may still be behind by 3 or 4 months or whatever, but they've been paying consistently on time for at least 6 months now. All right. That's the big difference between a performing, non-performing, or reperforming note. Okay. Owner finance notes. Yes, you can buy performing and non-performing owner finance notes. Okay. Contract for deeds, which is kind of a non-institutional debt aspect. It's a great tool, especially for lower valued properties under 100,000. A lot of times we'll see contract for deeds. You'll see a lot of landlords, especially on smaller valued assets, if they want to owner finance the property to the tenant, they'll do a contract for deed. Not so bad. Lease options, sometimes you'll see. We'll see even reverse mortgages that we can buy, which is a little bit different. It's an institutional type of note, but it's not more of a cash flow note. A reverse mortgage, if you're buying that note, the borrower has passed away, and it becomes more of an REO play. But we'll get to that later on. So where should you focus? Okay. Should you focus on cash flow versus property? No, you should always focus on the cash flow. If you're coming to me, and I'll give you an example. Say, I live in Modesto, California. I want to use notes to buy more property in Modesto, California. I would say, I'm sorry, you probably need to go do something else. Okay. California is not a friendly state. I don't buy much in California. And if you're looking in just one specific area, like I live in Austin, Texas. If I wanted to buy notes just in Austin, Texas, I would have gone bankrupt years ago. The beautiful thing about being a note investor is the fact that you don't have to be a control freak. We're all control freaks here. I say that affectionately because I am one of them. All right. Control Freaks Anonymous. There's a group that meets every Thursday. Okay. Um, you can do this without you having to go see the property, touch it, feel it, rub on it. That's the thing. It's a passive aspect in a lot of cases. I've bought thousands of notes and I help my students close on thousands of deals where probably 95 to 99% of them is outside their home area in other areas of the country that make better sense than buying, say, in California. For what I can buy one note in California, I can buy 5 or 6 in Cleveland. Okay. The property side, yes, sometimes we do foreclose on it to get the property, but we always have to understand that we need to make sure that if we buy that note and the borrower comes back to the table, it's going to cash flow. Okay. You're looking for higher ROIs. Oh, I want to make, an 8% or more return on my money. You can do that. You can do that passively. Well, I want to make 15% or greater. Okay. Then you need to do that more actively because of what it's going to take for you to get that return. You're going to be probably spending a little bit more time buying non-performing than the performing note side. Okay. I want to look at, like I said, inventory, state, or asset class. I'm looking for 100-unit apartment complexes. Okay. You're going to maybe see some of those, but it doesn't necessarily mean you're going to be getting a great deal. Doesn't mean you're going to own the property. You're going to own the note. You have to understand that coming in the note space, you have to think like a banker, not like a property owner. Okay. A lot of real estate investors come into this, oh, I'm going to buy notes at a discount so I can own the property and all this equity. Well, you don't own the equity because you don't own the property. You're entitled as the bank to collect on the legal balance that's owed. Now, if that legal balance is more than the property is worth, well, guess what? You're upside down. You're not going to collect on it all. If the property is more than what is owed, for you to get that whole property, you would have to foreclose, hope nobody bids you at the auction, and then take the property back that way. You may be able to work a deed in lieu with the borrower, cash for keys. Yes, that's possible. We do that from time to time. But for the number one aspect of it, you want to look at stuff and think of the United States as your oyster. Okay. There are a few states you want to avoid. Okay. But for the most part, you can buy in multiple states. I buy in about 20 different states. Okay. 20 different states from the comfort of my own home in Austin, Texas here. Okay. You can do the same thing. Pricing is going to vary too. Some states are more expensive than others. Some states are more expensive than others because it's faster foreclosures versus other things. The higher valued assets versus lower valued assets will vary. Time. This is an important thing to look at with anything that you're going to take on. Time. How many hours per week? Oh, I got to put another 40 hours. I have to create another job for myself. No, we do not want to do that. Okay. But we're talking, if you want to do this, even on an active basis, 10 hours a week, 10 to 15 hours a week for what you want to do. Because the way we teach, especially in our 3-day class, we show you how to find and put systems in place so that you can drip market. You can reach out pretty easily to people and asset managers out there. And I highly encourage you to go watch this video, 100K in 12-month videos. Okay. We show you how to make 6 figures in 12 months. We're about to re-record this actually next week and update it. But this link on here, and what you should also get when I send out a follow-up email is updated slides. So all the links in here in my slides will be in that email I send out to you guys if you want to go back and recap it. And we'll put a recap of the videos in here for you. Okay. Foreclosure timeframes are also going to vary across state by state. Some states are faster, some states are slower. Okay. Now, the states that often have the longest time frame, actually all of them that have the longer time frames, are judicial foreclosure states. Now, what does that mean? Well, you have to look at the 2 different types. There's judicial foreclosures and non-judicial foreclosure. Now, non-judicial means it doesn't have to go through the judiciary process. It doesn't go to the courts. Judicial foreclosure means it has to go through the court system to foreclose. So with judicial foreclosures, you have a little bit longer time frame and process. Cost for judicial foreclosure, $2,500, $3,500 less, usually depending on what state it's in. Most of the judicial foreclosure states are east of the Mississippi. And in the longer states that have the longer foreclosure time frame, you'll get a little bit of a cheaper price point because you're buying in those states like New York, which takes you 2 to 3 years to foreclose. If you want to buy there, fine, you should get a little bit better price than say you're buying like in Austin, Texas, or Texas, which is a non-judicial foreclosure and a fast foreclosure state. Non-judicial foreclosure is shorter time frames, anywhere like 21 days here in Texas to like 120 days like in Oklahoma. Okay, pretty fast, less expensive. Here in Texas, I can foreclose for about $1,000 to $1,500. A lot of those are west of the Mississippi. And if you're just focused on, some people like, oh, I just want to buy in Georgia and Texas because they're the fastest foreclosure timeframes. You can do that, but they're at a higher price point because of the faster foreclosure process. The banks know these, the lenders know these. Okay. But that's something to think about. Now, I'm not going to sit here and tell you to go just buy in non-judicial states. Some people teach that, and I think that's stupid. Yes, I think that's stupid. Okay. Because if you're targeting cash flow, if you take out New York and New Jersey, which are the two worst states out there, most of the deals that we see, if they're occupied or owner occupied, and they've tried to make a payment, and by basing their due diligence stuff, if what we can buy that note and what they start paying monthly is a decent deal, why not? So I always teach people to buy in like 3 to 5 states to start off with, a couple judicial and a couple non-judicial. Okay. If you're living in Ohio, Ohio has a judicial foreclosure. I like Ohio. I like the Ohio State University area. Okay. I like parts of Cleveland. I like Cincinnati. I like Dayton. I like Toledo. Ohio's got a great market. And then also, if you look across the border to Michigan, Michigan is a non-judicial foreclosure state. Lots of great stuff up there. You don't have to buy, in the slums of Detroit. There are plenty of other great cities in Michigan. So get an idea to look at those 3 to 5 states. All right, if you're down in Florida, Florida is a great market, but it's also a judicial foreclosure state. And there's some other things that are causing things to be a little bit harder there. Insurance, property taxes are going up and things. It's getting a little bit more expensive than it used to be back in the day. All right. I'm not going to sit here and roll off what every state is. That is something that you can use the tool Google for. All right. Now, licensing requirements. This is a question I get all the time. Do I need a license to buy notes? And the answer to that is yes and no. It all depends on the state and what you're doing. Okay. Now, the beautiful thing is, as note investors, we're not doing the work out ourselves. We're not collecting rent ourselves. All right. Our borrowers are mailing in or ACH in their monthly payments to a servicing company. Okay. Now, it's about 75–80% of the states out there have some sort of debt collection requirement. But the caveat is, if your servicer is licensed to collect debt in that state, that usually solves the issue. You don't need to carry a license if your servicing company is licensed in that state. Okay. Now, do you need to hire a servicer that's licensed in all 50 states? No, you don't, because you're not buying in all 50 states. Okay. A lot of the servicing companies you'll deal with, probably to begin with, the Allied Servicings, the FCIs, the Madisons, the Select Portfolio, the Covey Financial. Those guys are not licensed in all 50 states because they don't carry notes in all day. Some won't even deal with New York and New Jersey because the licensing requirements up there are a little bit strict. That's okay. Some states don't require you to have a license, but you really do need to have a servicer. If I find out that you're going to be self-servicing your non-performing notes, you're going to get a strict talking to, because I think that's a dumb thing to do when you could pay somebody $15 to $35 to $95 a month, $35 roughly or under for a performing note, $90 probably for a non-performing note to do most of the workouts for you. That's what you should do. Be smart. Don't work harder, work smarter. Okay. Now, there are some states out there that want you to have a separate license, like Georgia wants you to have a mortgage broker's license, unless you're using your self-directed IRA to buy the note. That's an exception, which is fine. Kentucky wants you to have like a special bond. I don't buy a lot in Kentucky. Illinois wants you to have a separate debt collector's license besides your servicer. Basically, you got to pay the pound of flesh or $750 for a license that's good for 2 years to the state. It's just how the state makes money up there in Illinois. Okay. But states like Oregon, Washington State, California, they're a pain in the ass. I don't buy there because they're not investor friendly. They want you to have a separate mortgage broker's license or separate debt collector's license in those states to basically buy debt. Now, this is all talking on the residential side. Commercial, they don't require you a license, okay? But on the residential side, yes, you're going to be dealing with homeowners, borrowers. You have to deal with Consumer Finance Protection Bureau stuff. Nothing wrong with that. Just make sure you got a servicing company and you're buying in states that don't require a separate license for you, okay? Ohio has a little kooky one where if you're buying second liens, they want you to have a separate license. I just don't buy seconds, so I don't worry about it, okay? But don't let that hinder you. Plenty of opportunity all across the country. Some states want you to be a licensed mortgage broker if you're buying in their states, like Georgia does. Okay. So just buy in other states. Or what we do to get around the license in Georgia is we'll actually buy through somebody else who's a mortgage broker and give them a cut of the deal. So I don't have to do it all myself. Okay. Talk with your loan servicing company as laws change. If you're going to buy your first note, just talk to a servicing company beforehand. Reach out to me at talkwithscottcarson.com and we'll guide you through that process. Okay. Now, what is available in today's market? Reperforming notes. We talked about this before. That means somebody like me bought a portfolio or bought a non-performing note at a big discount, 40, 50 cents off the dollar. We worked with a homeowner, got them back on track, and they started making payments for 6 months at a time at least. That's considered a reperforming note. Now, some hedge funds out there want to say, oh, the borrowers express interest in reperforming, but they haven't made a payment. Oh, we're gonna sell this like it's a reperforming note. Well, they haven't done it, so don't pay for it like that. We'll get more of that later on. Non-performing notes, yes, we still see plenty of non-performing notes, somewhere between 3 to 5 million non-performing notes sitting out there for you to cherry pick from. Okay. Now you're not going to go buy from Bank of America, Chase, Citi, Wells Fargo, but there's plenty of other lenders out there that have plenty of stuff available. Contract for deeds are still available. A contract for deed or land contract is basically where a property owner wants to sell a house on terms, but it's really under 100,000 in value. So they offer up a 30-year mortgage at 9.9% interest. It's not based on credit. If the borrower can bring a down payment to the table, cash down payment, the seller's carrying financing, but the deed is still staying in the name of the property owner or the investor. But the borrower is paying on a mortgage. They're paying down the mortgage. They're getting interest deduction. They're putting insurance on the property. It's a great thing because it's often faster to foreclose in some states than others in a contract for deed. About half the states out there treat contract for deeds as a tenant relationship. So like if I buy contract for deeds in Indianapolis and the borrower stops paying, I can evict in 14 days there and turn around, cancel the contract, and go do it again. Other states like Florida treat contract for deeds as a mortgage, so you still got to go through the whole process. It varies a little bit state by state. You'll want to talk to your attorney or your servicing company on that. Non-performing commercial notes. This is no surprise. We see a lot of this. If you're going to dive into the commercial space, you need to understand the underlying asset. I mean, RV parks are different from office buildings. Office buildings are different from apartments. Apartments are different from industrial stuff. Okay. Self-storage facilities. We've seen every type of commercial asset being distressed, and there's ways to find that stuff. I will not be going through commercial notes on today's training just because it's a completely different ball game depending on what type of asset class you're going through. Okay. You'll see old notes sitting around too on platforms like PaperStack and other places that have been around for a while. Yeah, it's been around for a while, and it makes sense for you to make an offer on it because you like the yield. Go ahead, make an offer. Make a low ball offer. It's been sitting around for a few months. Okay. I don't buy a lot on platforms. They're not worth my time when I get better deals and I'm direct to the seller versus having to go through the back and forth through a third party. That just aggravates me. If I want to buy a note, I want to buy it direct from the seller, and I don't mind paying brokers. I mean, wrong. That's not what I'm saying. I'm simply saying there's a lot of platforms out there that have old stuff sitting around and they don't take any time to update their lists or really hold the sellers accountable to respond. Okay. You can also buy newly originated owner finance notes. Oh my God, there's some Facebook groups that I see this every day. I've got a newly owner finance note. I'd like to sell the note. I am not a fan of owner financing. If you're going to sell a property, okay, sell it traditionally. If you sell it owner finance, you're not going to get the full value. This is the biggest mistake I see people making is they think owner financing is a phenomenal thing, and they're going to turn around and sell the note to somebody like me at full value. You're not. You're going to take a discount. It would make more sense for you to structure the deal where you're carrying a second for a period of time and just getting paid off cash, or you're taking a hit on the upfront and taking a discount when you sell it just to be done with it. Biggest mistake I make with owner finance notes that people come to me all the time is the interest rate's too low, or they did a 100% loan. They don't want to take a discount because they can't take a discount because they either overpaid for the asset or they over rehab it. Okay. Owner finance note, creating owner finance notes is for you to carry the paper for a period of time for cash flow. You need to be expecting to carry the owner finance note for 12 months or longer to get the full value for it. Originating a new note to somebody who has a bad credit score or is low down payment is a recipe for you taking a bigger hit. Don't do that. All right. Just don't. Understand what you're doing and go from there. And I mentioned earlier before, you need to have a banker's mindset in this business versus that REO landlord or the fix and flip mindset. Because like I said before, you're not actually going to be getting, all right, the actual full equity of the property, especially if there's equity. That equity belongs to the borrower. If you take it to foreclosure, all right, you're going to get what's owed. That's your maximum offer to bid. If the house is worth 200 and you're owed 150, you bid 160. Guess what? You're getting the 150 to yourself, and then the 10 grand extra is going to the borrower. It doesn't go to you. This is the biggest mistake we make. You're buying the note, not the property. Quit chasing equity. All right. It's not a smart play. Can you get it from time to time? Yeah, you can get it from time to time. If nobody bids at the auction, guess what? And there's a ton of equity, you take the property back. Now you have that equity. All right. But you have to be prepared for either aspect of it. Now, so you want to streamline. When I say streamline your product's focus, I mean, know what your buy box is. Okay. I'm not going out and chasing usually $1 million properties because that takes up a lot of capital. It takes up, I've done that. I've bought $1 million notes before. Okay. And yes, there are some things to it, but you deal with a whole lot more headaches. $1 million notes don't usually cash flow very good. Okay. You want to avoid the shiny object squirrel syndrome. If you're one of these guys or gals that goes from class to class to class to class to class to class to different workshop on different things, to have different tools to your tool belt, then note investing probably is not for you. Okay. Because here's the thing. You have to put some marketing and some time in, and notes take a little bit longer than your fix and flip or a wholesale deal. I was telling people, especially in non-judicial states, budget for a year at the minimum. If you're buying in non-judicial states, just go ahead and budget 2 years for this deal. Why? Well, because it may take you a year to foreclose, fix the property back, and turn around and sell it then. All right, there's nothing wrong with it. If you're buying at the right price, we're still going to make a higher return than what the fix and flipper is doing. Or make a higher return, especially than the wholesaler is doing for the most part. All right. And we're making more money versus just a flat check. Okay. So avoid shiny objects. Like I'm a vanilla guy, 3-bedroom, 2-bath, 2-2s. I'll look at 1-1 condos as well from time to time, but I want single family homes. Duplexes and triplexes and fourplexes. You can find those as well. You'll see that on here as well. Okay. But I always want the cash flow to make sure cash flow is good is the number one priority. I'm buying at a discount, so I'm creating my equity in the deal. It doesn't need to be technical true equity, but since I'm buying the note at a discount, I'm creating the equity beneath what's owed because I bought that debt at a discount. Borrower still owes the full amount. I'm just getting it because I'm buying that receivable or that problem borrower, taking on that nightmare of the banks. I pay and get a discount. Taking back real estate and doing fix and flips should be your secondary for most of the time. There is one asset type that we do target, reverse mortgages, that you are not a cash flow basis. You're not going to get a dead borrower to come back and start paying. If you do, that's a miraculous. Okay. What I'm saying is in a reverse mortgage, if you're going to buy those, it's strictly a fix and flip deal with that. Everything else is going to be a cash flow aspect. All right. And then even with the fix and flips on the reverse mortgages, half the time we'll end up selling the auction and not have to do a bit of work to them at all. Okay. But there's a lot of different things that you can look at. The idea here is pick 2 or 3 things that you like, stick to those things, and just focus and stay in your lane. Avoid getting sucked into all the other big things. Well, I'm going to do apartment syndication. I'm going to do some land development. I'm going to do some wholesale. I'm going to do some private lending. Don't do that. Don't drive yourself mad because you're never going to give enough bandwidth to one niche to be successful at it. You're going to be upset because things aren't going your way, and that's okay, but you just did it to yourself because you tried to do too much. Here's a great thing. When I teaching my class, listen, if you're going to focus on notes, focus on notes. It's great. Another byproduct of note investing is dealing with subject to deals. We get all these lists from banks and lenders. If we're not going to buy them at a price that makes sense, we do target those other borrowers for potential subject to deals if the rates make sense. Okay. Some options there for you, but we'll get to it later on. Any questions before we dive into session 3, note sellers? Moving on. 1 second here. We'll probably take just so everybody knows, we'll probably take a quick little break right at session 5. Just so that you can get up and get rock and roll. I'm just trying to monitor here the videos, the live stream here for everybody. Oh, come on. Why is it always giving me a hard time here getting on? All right, let's do this. There we go. I think we're cooking with Crisco now. Yeah. All right, let's dive into note sellers. One of the great things about that we teach that most people don't show you the way is how to find actual note sellers. I'm not going to sit here and give you my list of contacts here, but I'll show you how we've built contacts. I'll show you how we create stuff. And especially if you spend time on our 3-day class, our whole full first day is all about really finding asset managers and how to create a river of deal flow that comes to you no matter what's going on in the market. I'm not saying every lender is going to have something every month, but guess what? If you have enough lenders, you're going to have something every month. Okay. So note sellers, places to find note sellers. Banks obviously have notes. Every bank sells their notes. You just need to deal with the right department. You're not going to contact the customer service line or their loss mitigation line. That's not going to work. You're going to go with the internal department names. Lending institutions like REITs, mortgage companies who aren't banks will have notes that they have on their portfolio. Mortgage bankers, all right? Mortgage bankers are like the loan officers who have their own like warehouse lines. They'll have stuff available. Servicing companies. There are some servicing companies out there like SN, FCI. FCI used to have a trading platform. It was all right. SN's got a new platform. They'll sell notes from time to time. And you can buy from there. I've bought some stuff from there. Some of my students have bought from there. So, all right. So we got, hey, Albert, hey, Heather, good to see you on the YouTube live stream there as well. Good stuff. Thanks for coming in. You can go to note conferences and connect with other note investors like yourself. There are sometimes funds that will attend these conferences for you to take a look at. I like going to servicing company conferences to find some of the bigger ways, the bigger conventions, the special servicing, the Mortgage Banking Association conferences. LinkedIn is a great place to find notes. Okay. LinkedIn's phenomenal. You can go to the banks and lending institutions and find people directly. You can find private sellers and through some of the Facebook groups and some of the LinkedIn groups, stuff like that. Private sellers are selling notes on a regular basis. If you're looking at a specific area, you can go to the county clerk or the county recorder's office of that county and do an assignment search. Look for assignment of mortgages because that's what's transferred every time a note is sold. Is an assignment of mortgage filed to the county saying, hey, this mortgage is no longer owed by Chase Bank, is now owed by Scott Carson Bank. All right. Foreclosure lists are a phenomenal way to find distressed notes and banks that have distressed paper. Now, if you buy a foreclosure list in one county, it'll give you a whole list of the banks that are foreclosures. Okay. Banks and private sellers on there. I don't target those lists for the property on those. I use the properties as warm leads into the bank sellers for bigger lists and bigger profits. Okay. We did a whole breakdown on finding deals webinar. You can check out the link there of us going through all the different ways. I'll probably end up reshooting that one here in the next couple of weeks as well. We're really excited. Our podcast is coming up on 1,000 episodes of the Note Closure Show. So we're excited about that. And we're looking back and re-recording some of our favorite episodes and from some of our favorite videos the last couple of years to refresh them and give them a new 2025 flavor, if you know what I'm talking about. The departments inside the banks that you do want to target, these are the internal departments. Like I said, not loss mitigation, not their customer service number. You're going to want to talk to somebody in the special assets department. This is for the larger institutions, okay? Like I can go and contact the special assets department for the commercial and the residential side, often some of the bigger institutions like the Bank of the West. I know both department heads and have bought from them on both commercial and residential assets, okay? Zion's Bank, I'll give you an example. Zion's Bank has one person in charge of residential in the special assets, and they have like 10 people in charge of their commercial assets all across the country. Okay. Another job title or department is a secondary marketing department. Banks and REITs will have a secondary marketing department. This is what you need to know is like when you're calling the 1-800 number, you're calling the corporate office, this is who you ask for. A lot of insurance companies, REITs, heck, you could go on LinkedIn, type in whole loan sales department, whole loan traders, and you'll find plenty of individuals who have this job title. Their whole job is to move the bank's non-performing assets, okay? So while someone may want you to buy in portfolios, others will still allow you to cherry pick. Now, when you get to smaller regional banks, your local neighborhood bank. You may be actually the loan officer, but I target banks that have at least 5 or more branches because they're going to be a little bit bigger and they're going to have more inventory and they're going to be a little more flexible in the pricing. If you're dealing with a one-off bank and the chief credit risk officer is over that one bank, they're probably the loan officer. They're not going to sell that note at a discount. They can't afford to based on the charter of the bank. But the bigger banks, the bigger regional banks, yes, you'll see more stuff here. But you can also look for chief credit risk officer as a job title. Okay. You can also type in note investor, note trader. Those are some more of the smaller ones. Portfolio manager, you'll see that as well. Now, there are some websites that we've put together to help you find notes. There's laneguide.com. Lane Guide's been around for 40 plus years. It costs about $165 a year for online access. It goes in and kind of tracks what banks have been sold to what banks, and will give you a lot of internal departments. We've used Lane Guide for years. Okay. Bauer Financial. Bauer Financial, while it will not give you like contact names, it will give you a list of banks that have troubled assets. Now, what Bauer Financial prides itself on is that it scrubs the quarterly reports that the banks and credit unions send in, banks to the FDIC, credit unions into their version of the FDIC. They have to report these things. So what Bauer Financial does is pulls these quarterly reports and it tells you, okay, how much in loans they have, how much in total assets, how much in non-performing loans, residential, how much in non-performing commercial, how much are in default, meaning greater than 90 days late, how much are in that 30 to 89 day late period for the next quarter. And it also gives a star rating, 5 stars, 4.5 stars, 0 stars. And it will give you like the CEO's president's name and then a 1-800 number. I like pulling this list on a quarterly basis to look at, okay, what is in default? Who's got the biggest default? And then contacting those banks through LinkedIn or those contacts that way. Okay. FDIC.gov will show you banks have gone out of business. They'll show you asset sales. In Texas, we have the Texas Savings and Mortgage Lending Department, which I love using. I can usually get a list of all licensed banks, bankers, servicing companies doing business here in the state of Texas. And then it also gives me contact names, contact numbers for the licensing side of those departments. But the great thing is now you have a phone number, internal phone number, and an internal email to reach the right person. Okay. And there's other states out there that have licensing websites or downloads you can do. A lot of the states will send you to the National Mortgage Loan Origination, the MLO website. That's kind of useless. You can use that website to find servicing companies, but it's not very useful in finding or downloading the list. Most of them, if you reach out to the Department of Finance, Department of Real Estate, Department of Insurance, stuff like that, whoever handles the licensing or the registration of mortgage companies or loan officers, that's who you want to reach out to in your state. Okay. I like Scotsman Guide as well too. I've used it more in the past. They changed their website up some. Now, Scotsman Guide used to be a big magazine that would come out to mortgage brokers and loan officers that would give you lenders that would do like kind of different loans or have their different loan programs. Scotsman Guide was really good for subprime lenders back in the day. I could literally go there and find 50 to 100, 200 subprime lenders that made great connections for me reaching out to buy non-performing notes. That's changed a little bit. There are subprime lenders out there still. They're a little harder to find. And Scotsman Guide it's gone from it being easier to find to being a little bit more of a gatekeeper in some of those cases, but still ways to use it. Okay. Now, there are some loan platforms you can immediately go look at and start looking at notes. Like you go to paperstack.com and look at about 130 notes. Most of their stuff has gone away from non-performing to a lot of land notes, a lot of newly originated owner finance notes. They're okay. I prefer to buy direct from a lot of the sellers. Watermark Exchange, they'll have some stuff, but honestly, they really don't have anything new. Val Satir, who owns Watermark Exchange, is more into doing a lot of DSCR loans. SN Servicing is a servicing company. You can go to their website. You can register as a buyer on their website and sign an NDA, and then their trader, David Polio, will add you to their list, and they'll send you stuff out on a pretty weekly basis. Deb Expert is another trading platform that's okay. It kind of recopies what's on PaperStack. FixedNotes.com will have some stuff available. It's usually a lot of low-hanging seconds, thirds. It's not really a good trading platform at all. 10xauction.com, I throw these in there because it's a lot of REOs, but their commercial side will list notes that are available for sale, or you'll see banks that are getting ready to foreclose on properties in the auction site. Well, guess what? I use the contacts or what bank is foreclosed on one property to find out what else they have and buy direct from them. Okay. What are you laughing about, Tiffany? Talking about Deb Expert or Fixed Notes or what? A lot of junk. I don't want to deal with junk. I want to deal with good stuff, right? Oh yeah, Deb Expert rarely has real estate notes lately. Yeah, they just they started off as a great website, but they just don't know how to market for deals. It's what happens when you have a couple software guys trying to be in the real estate stuff. Okay. Mission Capital is a bigger player in the non-performing space, but it's more so with the banks and hedge funds. You've got to register with them. The same thing with Note Trader Exchange will have some residential stuff. Note Trader Exchange is a little difficult to work with. I'm just going to be honest. I've had plenty of students that we've reached out to them to see what they have available on their platform, and it always seems to be, oh, we're going to have a list later on. Okay. DebtX is a big platform that a lot of banks, hedge funds will post stuff on there. You've got to pay a registration fee to evaluate their stuff. And often it's stuff that you're not going to buy. It's just too big a portfolio starting off. You can put it as a goal to be able to buy off those platforms later on as you get rock rolling. But when you're starting off, you're going to be better off targeting the banks, targeting a couple sellers and stuff like that to find stuff that will direct you. Okay. Questions about the different types of trading. What's the fee for DebtX? I think it's 500 to 1,000 what it was previously. And then they got to approve you. They're going to ask you to fill out your Patriot Act form, everything about your LLC. Yeah, usually it's a year. Yeah. What? Maybe it's just a one-time fee. It just varies a little bit. I haven't bought from them because when I did register for them, we saw stuff on there, but it was like huge portfolios. I'm like, okay, I'm not going to waste my time chasing a $100 million portfolio. I can make good money and a great return on my life by trading, 5, 10, 15 notes at a time versus trying to trade 100. It's a lot easier, a lot more buyers for 5 to 10 there is for 100. Yes, if you land that whale, by all means, good for you. But you're going to go broke in the process of trying to land a whale to buy a $100 million portfolio, especially if you're starting off. They're not going to deal with you. They're going to be able to smell that you're brand new and not take you seriously. Don't be a joker broker. Go buy something for your own portfolio. Go raise $50,000 from your friends and family and go buy 2 or 3 notes and make a great ROI on that stuff, and then go and rinse and repeat. Much easier to do. Okay. All right, let's talk about note scripts. By note scripts, I mean there's things that you want to say and things you do not want to say when talking to bankers. Now, the biggest thing is when you're contacting banks, understand that you do not want to, don't overpromise, don't be an idiot and try to look bigger than you are. It's better to be honest in a lot of cases. Bankers, asset managers, I can tell if you're a fakey in the first 5 minutes based on what you say and how you say. Okay. Do not be one of these people that says all these big words and is very kind of vague in nature. Don't come along and say, I buy anything. That's not going to work. Okay. But your basic elevator pitch when you're actually, whether it's via email, via LinkedIn, via phone call, is once you get to the right department, the right person is asking simply, what do you have on your books that you're looking to move this quarter, this month or next? Okay. What are you looking to move this month or quarter? Okay. I'm looking, or we're looking to buy for our own portfolio. I say that all the time. I don't say I'm trying to flip it. Even if you're trying to wholesale it, still say, I'm trying to buy for my own portfolio. It adds value. Bankers don't want to deal with wholesalers and flippers. They want to deal with direct end buyers. Okay. I'm looking for something with some hair on it. That means it's non-performing. It might be a little hairy. Okay. That's going to be the ones that are going to have the most value in offloading to you from the banks. Okay. I'm looking to work it out with a homeowner. That's what they always like to hear. If we foreclose, we'll foreclose, but we're willing to try to work it out with a homeowner in some sort of fashion. Okay. Banks, honestly, a lot of banks, especially regional banks, do not want to be the bad guys. All right. They would rather sell the note to somebody at a discount, let them be the bad guy in foreclosed. Even on performing stuff, even on we've had plenty of students who've gone and bought portfolios from a bank, 15, 20 notes. And it was a product that the bank used to have didn't offer, but they didn't want to be the bad guy foreclosing. So they sold it to somebody else so that they could still be the good guy. Okay. And we're looking for notes in these markets or states. Now, I don't really get into individual markets like Austin, Georgia, Nashville. Don't say that. Don't say individual cities. What I would simply say, we're looking for non-performance in most of the major markets. Okay. In most of the states, excluding West Coast states or excluding New York and New Jersey. That's what you should say. Oh, I only want to buy in Texas. Well, then go do something else. Okay. Do not say this. I have 20 million a month to buy. If you had 20 million a month to buy, you would have somebody else calling, or you would be buying institutionally. Okay. You would be filling out your QIB form. What's a QIB form? That's a qualified institutional buyer form. If somebody tells me they got 20 million a month to buy, the first thing I say, great. Can you send over your QIB form? Huh? Qualified institutional buyer. If you don't have that, you're not willing to fill that out, we're not willing to talk. I'm looking for notes and REOs. No, you're not looking for notes and REOs. I know you got some realtors on here or realtors watching. I want to be the REO agent. Look, if you want to be the REO agent, then go be a realtor. No offense. Banks don't need you to sell their REO. If you call a bank and ask to speak to that you're looking for notes and REOs, that person is going to send you to the REO department, which is usually a voicemail box that nobody responds to. It's usually got to say, hey, call the listing agent, because the banks are going to list it. Okay. I never ever say REOs. I say I'm always looking for notes. I'm looking for non-performing notes. I'm looking for your special assets, your secondary asset manager departments. Who is in charge of the liquidation of your bad portfolio? Okay. The REO hate. I don't have hate against REOs. I've bought REOs in the past, but if you're calling, this is the problem. We're not here to teach you REO investing. We're here to teach notes. Note weekend, not REO weekend. This is not REO Speedwagon. Okay. Look, I create my REOs when we foreclose on notes and then take the property back. And no, don't call me up and say, hey, I want to list your REOs. I want to buy your REOs at a discount. No, I create a discount for my profit, not for you. Okay. I get a realtor once a week at least calling me, hey, can I list your REOs? No, I don't need you. No offense. I need realtors for due diligence stuff like that, and I need realtors to list my REOs at full values, but I'm not going to sell it to you at a discount. But don't call the bank looking for REOs. It's a waste of time, and we'll just say I'm looking for notes. That's what I'm looking for. Okay. Don't say I'm looking to broker a wholesale. They'll just hang up on you. Okay. Don't say I represent a buyer. I'm a buyer's mandate, a buyer's rep, a seller's mandate. Blech. Okay. Makes me want to vomit when I hear that. Just don't tell me that. What happened is somebody was teaching those names and thoughts and they never follow through. And it would be, they were just became joker brokers. Or say, I'm looking for anything. First, second, residential, commercial. No, you're not. You're just trying to wholesale. Okay. If I'm a solid buyer, I have a niche or two that I'm looking at. Like I'm looking for, like my buy box is I'm looking for non-performing first liens. Okay. I prefer really under $1 million. 500 or less is actually my buy box on the residential side. And if you do have commercial, I'm looking for that small balance commercial, 5 million and under. Okay. That's my buy box. That's a specific aspect of stuff. Notice I didn't mention cities. I'm looking just in Austin, Texas. That will not get you anything because you want to make, here's the thing, you want to make it as easy as possible for that asset manager to log into their computer and hit the download spreadsheet button and send you the spreadsheet. Okay. You want to make it simple for them. Then you can look at the state and zip and areas yourself. Don't be lazy. If you're lazy, they're going to be even lazier. All right. You want to be smarter and help them fit. Yeah. Just send me what you have on the non-performing note side, and I can get back to you in 24 to 48 hours with a bid, with an indicative offering. Doesn't mean a final bid, but yes, you can get a bid back in 24 to 48 hours, pretty relatively easy on a couple things. Now, some of the sources that we talk about, Lane Guide, you'll be able to build a list. Going to servicing conferences, you'll be able to build a list of emails and contacts. Okay. What else? The state mortgaging licensing websites will give you contact lists. If you're going to be emailing asset managers or contacting asset managers or bankers, here's the best time to do it. You want to email them on a Tuesday, Wednesday, or Thursday. I know some people are scared to email these days. If I can't find them on TikTok, I don't want to do it. But there are asset managers on TikTok, surprising. I've had some big hedge funds and big banks and stuff like that reach out to me directly off some of my TikTok and YouTube videos, which is always surprising. But it is. But still the best thing that we do is send out an email blast once a month to our asset managers. And if you want to send that email out and what do you have this month, send it on a Tuesday, Wednesday, or Thursday. Send it so it hits their inbox. between 10 and 3. All right. You want to use a CRM tool like REI Blackbook or Keep or something that allows for you to send it to them at a specific time in their time zone. Okay. Sending through Google or Gmail or Yahoo itself isn't going to work. Constant Contact, iContact, they are horrible CRM tools. Okay. But when you send an email blast out through like REI Blackbook or even MailChimp, you'll see about a 10 to 20% open rate the first time. Okay. So if you send out to 1,000 emails, you'll see a 10 to 20% open rate. That's great. That's the first thing. That's just the start of a drip marketing campaign. Drip marketing means you drip on them every month. Okay. We send that same email out a second time to those that didn't open it the first time. And we see an additional 5 to 8, sometimes 10% open rate on that second email. And then we send it a third time to the third group that still didn't open the first two. And you'll see a 1 to 4% response rate. Because some people look at their emails different times. And yes, it's the same email, but the first group that opened it don't get email 2 and 3. Group 2 doesn't get email 3 because they opened it. And I can see in my CRM who opened it and who didn't open it. I can see which emails bounced, which I save, and reach out to those banks or those lenders, say, hey, John Smith, who used to work over here, I see his emails bouncing. Who's in charge of his position now? Okay. You want to send your follow-up email 48 business hours apart, and usually at the end of the day. So if you send the first one at like 10 a.m., send the second one at like 2 p.m., 2 days later. If you send it at 2 p.m. the first time, send it at 10 a.m. the second time, and switch back and forth, okay? Pretty easy to set up in a CRM system. Okay. There's two things that I think work best or really good for new real estate investors. I use Keep. Keep is expensive. Keep is like the mothership. Okay. I have a 70,000 person database. Okay. You don't have that. So starting off, MailChimp's pretty easy to use, but I think REI Blackbook is actually going to be better for you. It's got a lot more bells and whistles to it. If you'd like a introduction to the guys over at REI Blackbook, I think they do like a 97 or 197 a month. It's pretty cheap, but they've got so many bells and whistles that can really help you streamline landing pages, all that good stuff. And their team is just phenomenal, really second to none. I just have too big a database for most places, so I'm a little bit different. But Blackbook, REI Blackbook, and MailChimp would probably be the first starting points for you. Okay, good question, Tiffany. All right, moving on. If you're going to call bankers, I know this is the scary thing. Oh my God, I got to pick up a phone and talk to somebody. All right, you're not going to do a text blast out to asset managers. That's not going to work. I'm sorry. That works for your buyers, sellers. All right, traditional. Okay, that's not going to work for bankers. You got to pick up the phone and talk to someone. But when you send out an email blast, you should get an open rate. I like to call the bankers that have opened my emails. There'll be times I do call blitzes too, leveraging Lane Guide or Bauer Financial or LinkedIn to find the right person. We've done call blitzes all the time here, and calling asset manager directly so you can see the conversation. It's not difficult. The best time to call is like emailing Tuesday, Wednesday, Thursday when they're more likely at their desk. 10 a.m. to noon. And 2 to 5 their time. Yes, they're in the office a little bit later. Friday, it's hard to reach somebody. I usually like to call the Thursday before the end of the quarter. Okay. I don't call the Friday at the end. I don't usually call the Thursday at the end of the quarter and end of the month. I'm sorry. I do call the Thursday before like the last week, because they're usually in the office trying to get reports to figure out where their portfolio is at and where it's going to be for the end of the month, end of the quarter. Okay. Expect to leave a lot of messages. Always leave a voicemail. Always leave your number twice. It's worth getting an email address. It's easy to understand. Okay, like I can say, hey, my name is Scott Carson. I'm with WeCloseNotes.com. I think you're the right person at your institution that handles in charge of your note sales. I'd love to talk about the assets that you have that you're looking to move this quarter or next. I can be reached at 512-585-3810. Once again, that number is 512-585-3810. Or you can reach me via email at scott@weclosenotes.com. That's scott@weclosenotes.com. Simple. Okay. Smile while you dial. If you're in a bad mood or you mumble on the phone like you got a mouthful of rocks or marbles, don't do this. Go do something else. Okay. Very important. These guys do not have time for you to waste, or gals, guys and gals. Be specific, be to the point, tell them what you're looking for, tell them what your buy box is, tell them what you're trying to do, and you'll have success. Okay. But expect this is the ratios that we see. It might be a little bit better now with AI, but 50 phone calls, you'll talk to probably about 14 people. You'll probably get 4 NDAs and you'll probably get a tape in or two. You may get more than that from time to time, but in the law of averages over time, that's what we've seen. Okay. Now let's down. Emailing, LinkedIn can be a higher hit rate. You just have to understand you want to automate. Since you're using LinkedIn, you want to use a tool like Octopus CRM, something like that, to reach out to asset managers at 20 to 100 people a day. Okay. Like I said, expect to follow up, send an email, make a phone call, connect on LinkedIn. All right. And do that again and again and again. This is how you build a list of asset managers. This is how you get deal flow that nobody else sees. And if this Ingle Dink can do it, you can do it. All right. If you're listening to some idiot out there tell you, oh, you're too small. Banks won't sell you notes. That's so wrong. This is proof right here that they will sell you notes. I have so many students who've made contact with banks and funds and had notes sent to them. Okay. If you can actually carry a conversation and you're not your worst enemy, okay, realize that yes, you need a LinkedIn profile. Yes, you're going to probably need a website. Yes, you're probably going to need an executive summary that talks about what you're doing. Be willing to put that work in to get some stuff. All right. Not difficult to do. We cover a lot of that in our 3-day class, especially with our one-on-one coaching. We'll hold your hand through it. But 80% of sales are made after the fifth contact. Fifth contact, that's follow-up. Over 50% of people will never even follow up with a lead more than once. Okay. If you follow up, you'll get deals. All right. And then once you actually do that outreach and you get a hold of somebody the right way, either phone, cell, email, put those on your hot list. Those are easier for you to dial for dollars. When I got started back over 20 years ago, I had a goal of making 100 connections at banks. Well, at the end of first month, I changed that to having 1,000 contacts at banks because it was pretty easy to make contacts if you stick to it. Now, making phone calls and dialing for dollars is really, that's going to be the most amount of work if you want to put into it. If you just want to do this passively, there's plenty of things off the websites and LinkedIn you can automate and stuff like that. Pretty easy to automate in your spare time after hours. You don't have to be full-time, 40 hours a week to do this. Okay. But if you really want to do this full-time, expect to put some marketing in. Expect to spend a little bit extra time to find more deal flow. Okay. We did a whole calling asset managers 4-hour video. If you go to this link below, you can watch me make phone calls and see how it's done. Okay. We do have an upcoming class that I want to share with you guys here. Just a quick little hit. We spend the first full day on finding note deals, how we find these, how we put these lists together, how we market these, how we drip market, how we automate our emails, our Octopus CRM, our LinkedIn outreach, our phone call blast, stuff like that. That's all handled in day one. Day two is about the funding, the marketing, the raising capital, and the due diligence. And Sundays, the different exit strategies out there. Okay. We also have a monthly membership you guys might want to take a look at. If you can't attend a class or can't afford the 3-day class, it's our Note or WCN membership. If you go to noteumbrella.com for $97 a month, you get a ticket to the virtual workshop. You get a reduced ticket to the in-person workshop, and you get a bunch of other bonuses, weekly training calls, and a lot of other good stuff there for you. That's noteumbrella.com. Okay. Let's take a quick little break unless there's some questions. We'll let you get a fresh cup of coffee. I got to refresh mine, and we'll come right on back. Okay. All right, I'll be right back. It is 11:07. Let's come back at 17 past the hour. I'll give a couple more minutes before we come back. I should probably just make it 5 minutes. Anybody any questions before we hit the record button, get going back again? Good morning, everybody. Hey, Heather, good to see you here on the Zoom. Hey, Sander, how's it going on in Miami this morning? It's cold in Colorado, SK? Oh, Heather, it's snowing out in Jackson Hole. Very nice. Very nice. That's gotta love it. It's February, right? It's gonna be 73 degrees here in Austin, Texas. Maybe even 79 tomorrow. And then we're expecting a cold front to roll through and probably freeze again by next weekend. Just in time for the Super Bowl. Yes, if the forms Albert asked, they're in the base camp. You have access to that stuff already, Albert. If you're part of the WC membership, you get access to the replays, you get access to the virtual workshop, the manual, all that's already in the base camp message board. You just got to look through the file folders for that stuff. All right. Good stuff. All right, we'll just give it another minute or two for those that took our little break to get back on here. Going to be 80s in Miami. That's nice. You got that mugginess going on down there. Yeah. Why don't you rub it in, Sander? Happy New Year, bud. Sander, I don't know if you were out of town, but a few weeks ago, maybe a month or two ago, I actually reached out to you, left you a couple messages. I know you were trying to put some money to work. I had a deal for you or your wife that thought would be perfect for you on your IRA, but I never got a response back, so I did put it with somebody else. So if you're still looking to do that, let me know. Okie dokie. You're welcome, Albert. All right. Let's get started again. All right, everybody. So session 5 is all about markets and pricing. All right. Because one of the things that's most overwhelming, totally understand why it's overwhelming, is if you reach out to an asset manager or you're part of a WCN crew and you're getting a list, or you're a one-on-one coaching student, or you're going to the workshop, whatever, and you've gotten lists, it can be intimidating. I'm like, oh my God, there's 165, or there's 289, or there's 903. What the heck do I do with these? And part of what we do is when we break down a tape, I don't know anybody else that's breaking down tapes online. Okay. We do this on a consistent basis on our YouTube channel, weekclosedon'ts.tv. If you go on there and look at tapes breakdown, it's a phenomenal way for you to understand it. But you're going to see us slice and dice. We're going to get rid of markets, but we don't want to waste our time in. Right. And we're also going to figure out kind of pricing model. If we're given a price, it's the best thing. When you get a tape in, you always want to ask, what's the pricing expectation? If there's no price expectation, then you got to figure out your best potential profit or potential pricing, or what your bids is going to be roughly be. And that number is going to change a little bit. All right. Depending on the asset, where it's located, the ROI, the payments, all that good stuff. But we'll talk kind of about what pricing is at to give you a bit of a structure. Okay. Now, market expectations, note markets will completely vary based on the popularity, okay, the market values, the foreclosure timeframes, the population. You want to stay above cities, or invest in cities that have 50,000 or more to when you're starting off with, and location. All right. Also, inventory, like Miami, where Sanders sunning his buns on 80-degree temperatures today. Very popular. You get people looking for stuff in Miami. Same thing for like Heather up in Jackson Hole. Jackson Hole's very expensive. Miami's got an expensive part. We don't see a lot in Jackson Hole. So even non-performing stuff in Jackson Hole can be more expensive because there's a lack of inventory up there for, distressed deals. Okay. Austin, Texas, very desirable city compared to like Austin, Minnesota. Okay. Austin's a much bigger city here in Texas than it is in the land of 10,000 lakes. So more expensive to buy here than say like Paris, Texas, which is outside of Dallas. Okay. So like I grew up in South Texas, down by Corpus Christi, Texas, on the coast, a small town called Ingleside. I think there's like 10,000 people there now. I would buy there all day long because I know that I have family down there. I have realtors and people that I know and trust. Right. For you, somebody like Sander who's in Miami having fun, it would not make sense for him to buy a non-performing note in down like Aransas Pass, Ingleside. It's just too far off. Now, yes, the reason I say yes, you can use servicing companies, attorneys to help out with it, but it's better off when you're starting off to buy in the larger city, so you have more connections, you have more vendors that can help you out. I have connections down there because I know that area. For years I've bought down there. Okay. If you're starting off brand new, stick to the bigger cities. Okay. That's what I'm trying to get at. If a property looks great, but it's outside of town, way rural, look at the days on market. Rural's often going to have a higher days on market. Now, we have a friend, actually, we're going to have her on the podcast here in the next week or so. She buys these big parcels of land and subdivides them up into like 10-acre parcels. She has a niche. People are looking for like 10-acre parcels, and she's got a niche. She's doing it around like Bentonville, Arkansas, and around like Dallas, Texas. That's great. She's got a niche in buying these bigger parcels and then subdividing them off. That's different. She's doing it. The way she's structuring it, there's a lot of need for people looking for like 10-acre parcels. Okay. That's a little bit different than you going out buying a note out in the middle of Timbuktu that nobody's around for miles. You get what I'm saying? Unless it makes a whole lot of sense for you to do it. And you may know more inside stuff about that specific asset or the city than I do. That's completely fine. But just keep that in mind. When you're starting off, let's the target is right here. Okay. If you think of a bullseye, all right, bullseye are the states that you're going to have some stuff in. The narrowed target stuff are people that you have relationships. Your backyard is great if you have stuff. All right. But if you're not in an area that has a lot of inventory, then you want to expand your audience out to a few different states. Okay. A few years back, I actually almost moved to Florida. I spent a lot of time down in God's waiting room. Bought a lot of stuff down in Florida. Okay. I probably should have just moved to Florida, just focused on buying everything down there. Came across my table. But I didn't. But that's okay. Now here, I'm glad I don't own a lot of stuff in Florida just because of what's going on in the market down there. It's not saying it's a bad market. There's still plenty of opportunity down there if you know where to look and what to do. Okay. But inventory is one of the most important things. Like I would not base my business off of just buying in Jackson Hole. Okay. Just don't see a lot of stuff there. You got to now what you would probably pay for one asset in Jackson Hole, you could buy a block in St. Louis or a block in Kansas City and have your money leverage it a little bit differently. Okay. Now what's hot? The most expensive note markets are like California still. It's stupid. People pay stupid prices there. Just doesn't make a lot of sense. Arizona is getting hot. It's been a little hot, but you've had a lot of stuff sitting on the market. So Phoenix is a different market of the Phoenix Metroplex, which includes like Scottsdale and Glendale and all that neck of the woods there for you. Get a lot of stuff get hit hard. The Airbnb fiasco in a lot of that cases. So you've got a lot of people that are distressed. So you'll see some stuff there. Just be careful. What you'll see is a lot of higher dollared assets are more in trouble in the Arizona market, $500,000 or greater in that $1 million price range sitting there. Texas is always hot. People always like to buy here because it's a fast foreclosure state. Okay. The thing to look at too, when you get something in, it's a lower balance note, or it's something that's like, why hasn't the lender already foreclosed? That's the thing you always want to ask. What's wrong with the note? Why hasn't the lender foreclosed? Because it's just a fast foreclosure state. Nevada, especially Sin City and the biggest little city, Reno, very hot markets. Georgia, people like it because it's faster foreclosure. Atlanta's obviously going through a big growth the last few years. And like West Coast, you have stuff that's overpriced in Oregon, Washington State, because Californians buying up that neck of woods. I just don't buy in those areas. I just don't recommend that you do. Okay. Not very lender or landlord friendly. Now, what's not hot? Least favorite markets: New York, New Jersey, Kentucky, Chicago, specifically Crook County. Unless you live in Chicago, don't buy in Chicago. Let's just put it that way. The politics of the city and that county are just horrible to anybody that's an outsider. How do I know? Been there, done that, lost $250,000 in that market. Okay. Also, you want to avoid assets that are under $30,000 fair market value. Now, years ago, a $30,000 asset could have been something that was once a $100,000 asset. Shit, we bought stuff in Arizona for $30K that was once $300,000 back in the day. Man, I wish that time would come back, right? Well, no, I do not, because we have a very bad stress situation. But when you're wanting to get rid of stuff off your list, that's kind of the first 5 points that you probably want to look to get rid of. Get rid of New York, get rid of New Jersey, get rid of Kentucky. You don't see a lot of stuff in Kentucky, and they've got the weird bonding issue. If you're an individual bond, they want you to put up a $500,000 bond. If you're an LLC, they want you to put up $1 million bond. Okay, just it's better to buy. Kentucky is like one of the few states that's better to buy an REO in, or like Louisiana too. Avoid high equity note deals if they want you to come in like 90, 95 cents a dollar. Just does not make sense for the most part, unless there's just a, stupid reason not. And this sometimes you'll see, but for the most part, and by high equity meaning 50 to 100 grand in equity or more above what's owed, the sellers can probably want you to be at that 90, 95 cents on the dollar of legal balance, and it doesn't leave you a lot of money in case it sells at the foreclosure auction, right? All right. Now, where is the most inventory now? We do still see a lot of stuff in Ohio, Michigan, Indiana. Okay. Those 3 states right there, you're going to see the most amount of inventory. And while Ohio and Indiana are judicial states, they're still pretty easy to foreclose in under a year. Michigan, a faster foreclosure state. But Michigan, you got Lansing, Bay City, Detroit, out in the northern side, not the south side of the city, Ann Arbor, Kalamazoo. There's a lot of great cities in Michigan that we actually like buying in. They've been very valuable. Grand Rapids, Michigan, another one. Okay. Indiana, the Hoosier state, plenty of bigger markets there. Ohio, bigger cities. If you just focus on the bigger cities and bigger counties in those 3 states, you would probably do pretty well. Illinois, outside of Cook County, okay, DuPage, Lake County, pretty easy to deal with. It's Cook County, which is the worst. Okay, kind of like Travis County is the worst here compared to everything else in Texas. Missouri, not a bad state to buy in, pretty relatively fast. You'll see stuff in Missouri, Kansas as well. Florida, God's waiting room. You're seeing a lot of inventory there. You just got to be very careful about buying condos because of the stipulations there's the HOAs. The insurance can kill you on some deals in Florida, especially if it's on the water, especially if it's on the West Coast, Naples, Marco Island, Fort Myers. That area has been hit hard. Tampa has been hard. So understand what it's going to cost you insurance-wise before you end up closing, okay? Tiffany, yes, it is more. Chicago is like Cook County. Totally agree to that. All right. Vacant reverse mortgages. You'll see more reverse mortgages coming across. This is where people that were 62 and plus, they refinanced out of their traditional mortgage into a reverse mortgage, which is like an annuity product, which isn't credit based. It's based on their equity. So they usually have a sizable equity. So the lender refinances them, and then all they've got to pay basically is property tax and insurance. Or the bank pays them, the lender pays them like an annuity monthly, paying down their equity. When the borrower dies, then the family or the heirs have the first right of refusal to come in and pay off the property, keep the property. Well, what happens is a lot of borrowers, families don't have the money to pay off the loan, and so these end up going to foreclosure. Well, they end up being sold as non-performing notes, and we like these deals because it's a pretty straightforward REO process. You're going to buy that note at a discount. It'll vary on what's owed, so you got to be careful what you buy. You're often going to have inspection reports, interior inspection reports, which we don't have those with traditional non-performing, and a pure straight line to foreclosure, depending on what that foreclosure time frame in that state. And now you're foreclosing, either sell at the auction or fix it up and take it back. And it's a pretty easy due diligence process on the front end on those things. And oftentimes you can, if they don't have an inspection report before you close, you can go walk them. They're on a HUD key. If you got a HUD realtor, you can get into these properties and see what kind of condition they're in. You also are seeing a lot of small balance commercial is struggling. You're also seeing some large balance commercial stuff that's struggling too. But a lot of that large balance stuff is getting bought up by Wall Street. Okay, but you can still find small balance stuff that's struggling all across the country. Pricing models. It's going to vary a little bit by asset, but non-performing. Let's talk about the first side. Non-performing negative equity, where they owe more than the property's worth. Okay. Now, there's a model called the stair-step model, which people sometimes get their underwear in a bind about. It's a guide. If a seller doesn't give you pricing expectations, then you have to go off the stair-step model, as we kind of call it. And it still works. We still buy stuff off the stair-step model. All right, because we're buying from banks and institutions and other stuff that we get plenty of inventory from. All right, if you're just trying to buy the best asset from one asset manager on one tape, and that's all you're just looking at, they may not want to let you do the stair step. They may want 80 cents on the dollar. It varies, okay? But negative equity is a stair step model. Now, if you're buying perform or non-performing notes with equity, house is worth 200, the non-performing note balance is 150, that's got 50 grand in equity, you're probably going to have to come in 80 to 95% of the unpaid balance or the payoff. Okay. You may need to try to insert a column in the spreadsheet and calculate rough estimated payoff. Okay. 80, pretty normal. You can still make pretty good money, especially if it's a reverse mortgage coming in at 80 cents a dollar. That usually is going to give you a pretty good profit margin in a lot of cases. It makes it worthwhile. In a lot of cases, as long as it's a clean asset. Now, if it's a trashed out asset, I don't do it. Contract for deeds. It used to be you could buy these stuff at 30 to 60% of the non-performing balance. And that you still can see those. Okay. Especially where they don't have any equity. Now, if there is those with equity, it kind of goes to the same thing, 60 to 80 cents on the dollar of the legal balance, not the fair market value. Now, if they owe more than the property's worth, then the 60 or less is still very proficient. Okay. You may not want to buy them. Junior liens, they're overpriced due to lack of inventory. A lot of those that have seconds on properties are fully encumbered. Doesn't mean I want to buy them because I can't own the property, can't take it back. If they're not paying the second and they're paying the first, you're going to hold on to that asset for 3, 4, 5 years. And I'm like I got an old student that reached out to me. Hey, Scott, can you help us sell the second mortgage? The house is worth 1.1. I'm like, okay, what's the balance on the first? 250. Okay. A lot of equity there. What's your second? 200. I'm like, okay, why haven't you foreclosed? Well, we're in the process. Our lender is now allowing us to foreclose. We have a date. When's the date? Like 6 months from now. So just because you foreclose doesn't mean she's going to end up with the asset. All right. Laura's going to drag this stuff out. BK. I'm like, no, it's not worth our time. Commercial. As I said before, commercial is going to vary by cap rates and asset class and what's going on with that asset. Okay. Now, yes, there's been a lot of 200, 300, 400 multifamily apartment complexes going to foreclosure where investors bought these assets at 80, 90 cents of the dollar back then, and they financed it with a bank loan, and then they brought in private equity from investors like you and me to fund the rest of the purchase and the rehabs. Well, we all know what's happened is that a lot of these have gone to foreclosure or going to foreclosure because they're not cash flowing. Now, the banks are usually not taking a big discount on these. Okay. They're not selling these for 40, 50 cents on the dollar like you used to back in the day. Okay. There may be foreclosing on them for the full amount that's due with the intention that they're going to take this property back. If it's a B, C plus, or even A minus, take it back and operate the property for 2 to 3 years, let the market kind of shake itself out. All right. Or they're going to take it back and partner with an apartment syndicator who does good management and partner with them on it. You're just not seeing a lot of 100 plus, 200 plus apartments coming across. Now, I've seen stuff occasionally, but it's stuff that was vacant. There weren't existing rents on it, fully rehabbed, and now they're vacant because bad management. You got to be very careful and understand what's going on. Nothing wrong with that, but I would actually rather buy 100 performing notes that I can put with a servicing company that works like 100 doors paying cash flow per month. If one bar goes in default, that's fine. I can foreclose them out. I'm still going to get 99 other people to pay. Okay. Now, one thing you want to look at what's owed on the taxes. So take your offering and reduce it by the amount of taxes owed. Now, if it's current year taxes, don't worry about that. But if it's more than this last year, like if it's 2024 taxes, 2023 taxes, go ahead and ask for a reduction of taxes owed. Okay. Got to look at taxes. It could be a big difference between it being good and bad. Like I just looked at a deal. The seller wanted 161 on this deal. I was like, okay, that's not bad. But then I looked and there's 24 grand in back taxes. I'm like, that's a deal killer. Okay. No, I'm not interested. Now I'm willing to pay the price if you deduct the taxes and give me a credit for taxes. So that I'm not paying 161. I'm paying what is that? 137. That would make sense. I can still make my profit above that 161 if I've got to pay. You know what I'm saying? Always look at taxes owed. Pretty easy to check taxes by going to the county taxing office of any county of the property it's located in. Okay. Now, when it comes to the stair step model, this is why it's kind of their stair step model, rough pricing when it's negative equity. Really, if you're buying the cream of the assets, anything like over $65,000 in value, you're probably going to come around 65% of the fair market value. Okay. So like if it's a $100,000 note, that means, and the house is worth about 110. I'm sorry, house is worth 100, debt owes like 110. Well, you would come in at about 65K, 65% of the fair market value. That's why you pay about 65K. Now, if there's $5,000 back taxes, take the $5,000 back taxes off and you're at 60. Same thing, 50K plus, you're being the 55% of fair market value. The 40s, 45%. In the 30s, 30 to 39, 35%. Anything below 30, 25%, don't go above that. It's got to make a lot of sense if it's a lower valued asset like that. Like, oh, it's a great little rental or a little condo or something I'm familiar with. Don't see a lot of these assets that make sense anymore because usually it's just a lot. Okay. No, I don't buy land notes usually. There's a market for that. I'm just not in that market. Okay. All right, moving on. I actually, here's the thing that surprises some people that are new to the note business is actually I like occupied assets. Okay. Unless it's a reverse mortgage. If they're dead, that's fine. I don't need the spirit occupying the property. We've had that happen before. We've actually pictures of ghosts in a vacant property in a reverse mortgage where the borrower's passed away. Kind of scary to see on tape. Scared one of my students, Scott, was walking a property, took some photos, and later on when he got back, he pulled the photos up. He's like, oh my God, I felt something. And there it was. I guess the ghost was dying to start paying on time again. Who knows? But the reason you want occupied, especially in the non-performing note space, is they're going to take taking care of the property. They might not be paying you, but they're usually in better shape. That means that they're keeping the AC on, keeping the power on. Water is on, and it's winterized, especially this time of year. There's also more exit strategies when it comes to making money from the bar getting back on track. Now, if it's vacant, they've moved out. You're not going to have a very easy time most of the time getting the bar to move back in and start paying. Okay. But with occupied assets, it's easier to reinstate or modify. It's easier to get a deed in lieu or cash for keys. Now, if they've moved out of the property, we try to do a deed in lieu, cash for keys. All right. That'd be a faster foreclosure process for us. That's nice. But if they're gone, they usually won't respond. Like I was working on this one down in Aransas Pass. This deal, the lady, it was on a vacant property. I was actually walking my mom's neighborhood, and there's this vacant property that looks like it needs some work. Well, I reach out and I'm actually able to get the borrower. She was willing to sign a release of information form for me. I contact the bank and I'm working on trying to buy the note and go back and forth. Well, they won't play ball. So I tell the borrower, like, listen, if you don't want this property, the bank's not going to sell the note. They won't respond. Then just deed it over to them. Deed it to the bank and walk away and avoid a foreclosure. She's like, I didn't think about that. I was like, just walk away. If the bank's not going to be responsive to you, just walk away. Emotional equity. If they're occupied and they got their kids there, they've put some landscaping in the property, they've updated the property, they don't want to be foreclosed on. They've got that emotional equity they like to fight for or work with you to keep it in a good way. There's also the biggest thing is if it's occupied and you foreclose, oftentimes you'll have less repairs that need to make. Less roof, less wiring, the electricity's there, the plumbing's still there, the HV, the air conditioner has gone on vacation and walked off. Occupied assets, most of the time are much, much easier to deal with. Yes, you'll run into the occasional hoarder. Yes, you're going to have to replace paint, carpet, and probably light fixtures in every one of them. All right. But that's still a small balance than having to go deal with a complete total rehab. Okay. Paint, carpet, a little landscaping is not big. You're not going to have to pull permits to do that. Okay. Full rehabs, then you got to do some things. All right. Questions about that before we move into session 6, funding options for notes. We'll get to more of the different exit strategies on session 10. I will go more of the step by step on kind of the waterfall effect of working out a deal with the borrower. Okay. All right, let's move on to funding options for notes. Okay. No, you can't go get a bank note or bank loan to buy a note most of the time. All right. Now, how do you pay for a note? It's going to be cash. Okay. You're going to send a wire transfer in from your bank to the lender. You're not going to close through a title company because you're not buying the actual property. The existing title of that property is still in effect. The same borrower is still in effect. So you're buying the note. So that's what you're doing is wiring the money to the bank or the lender. What they do then is they issue an assignment of mortgage the next day. They send you a scanned copy of it. One will show up a week later, a couple days later, with that ownership transfer that you can go get recorded, or they'll go record it for you sometimes. Every seller's a little bit differently. And then they'll send the collateral file, the loan file to you, usually 30 to 45 days later. Okay. Let's see here. If you've never sent a wire transfer is not expensive. It could be anywhere from like $8 to $35. And if you're worried about that, Paul, that's just a cost of doing business, bud. Okay. You're going to send wire transfers. They are not expensive. It's a cost of doing. That's how banks work in wire transfers. Okay. You're dealing with banks. You're dealing with lenders. Okay. Now, the thing is, before you wire, you always want to make sure they're a legitimate seller. Okay. All right. Make sure that you're not dealing with fraud. I've seen people who have been scammed by different fraud things. Like even Barbara Corcoran from Shark Tank lost 400 grand sending a wire transfer to a fake account because whoever was the scammer artist knew she was closing on a property. So they sent information over with false information. Okay. So when you send it, you want to make sure you're getting the right information, verify it with the bank or the seller, and make sure that the seller has the right to sell the note. Okay. This is why I don't like to buy. I'll buy from some brokers, but what brokers do, the legitimate brokers, is that they'll step out of the middle. You'll sign a fee agreement if they bring you a list, and then you've got direct contact with a bank or asset manager. And the wire instructions are often going to be in a loan sale agreement. It's not going to be sent in a separate email or separate text or things like that. Okay. Just the cost of doing business, not a big deal. You can use your personal and business lines of credit if you want to buy a note. Just realize you're going to have obviously a cost associated with that money. So make sure what you're buying is going to cash flow at least what you're paying on your line of credit. If you're looking for more lines of credit, you're going to talk with my buddy Merrill Chandler at getfundable.com. He's phenomenal at helping investors get $50, $100, $200,000 lines of credit with a personal and or business credit. This is not a credit repair, not one of those things. Merrill is the credit messiah when it comes to helping people. I can't tell you how much money he has saved us, how much in the lines of credit he's helped us get. Phenomenal by using his strategies, his techniques, hundreds of thousands of dollars saved in interest alone by being able to put things in the right spot. Okay. Like I said, phenomenal dude. I'm a big fan of his. I think his Get Fundable Bootcamp that he does, it's a 2-day course. If you go to getfundablebootcamp.com, I think it's required for everybody. It's you'll learn more in that about credit and things than you will anywhere else out there. You're going to use a lot of times, though, if you don't have your own funds that you're wiring out of your IRA or your checking account, stuff like that, you're going to use other people's money. All right. And using other people's money is not a difficult thing to do. Yes, it's intimidating if you've never done it before. But once you realize, oh, this is not difficult at all, it's pretty easy to raise capital if you've got a good deal. I mean, 95% of what I've bought over the year, probably closer to 99, has been with other people's money. Other people's money from their checking, savings, their self-directed IRA accounts, and it's creating a win-win scenario. Now, self-directed IRAs, you can do Roth or traditional. You can do a solo 401k. You can use their SEP IRA. People can use their self-directed HSAs. You can even use an educational IRAs to buy notes in. All right. There are a whole variety of different types of IRA accounts. You want to go to this link and read all about them, the amounts going. But I'll give you a bit of an idea. Here's the 2025 contribution increases for this year. Okay, so last year with your traditional IRA or Roth, it was $7,000. It's still $7,000, but you do have a catch-up policy of $1,000 more if you're 50 or older. A 401k, you could put $23,000. 23.5 is this year, so it's gone up a little bit. If it's a couple, you could put a combined. What is that? Oh yeah, employee plus years total of 70,000. Individual HSA, you can put 4,300 as an individual HSA this year, or 8,550 as a combined. You've got to have some requirements like a high cost deductible on that insurance plan. Solo 401k, you can put 23.5 away in your own solo 401k. If you have a SEP IRA, you can really put a chunk away, $70,000 a year. That's up by 1,000 in your SEP IRA in contribution. That's phenomenal on that. Okay. Great stuff. If you're don't have a self-directed IRA, definitely want to get one. It's one of the things that go to creating wealth. You can buy notes in all these accounts too, versus just borrowing money from individuals in this. And one of the things that we teach that I'll talk about briefly is how we raise capital. Okay. Now, if you're buying notes, and you're borrowing money from, there are some funds out there that will lend like 50% or 70 or 75% of the balance of the note. These are usually on bigger balances. Okay. And they'll do a collateral sign. We bought a $400,000 note on a $1.1 million property a few years back. And we found a fund in Miami that financed 85% of the purchase price of that note. And what they did is they did a collateral assignment. We actually had to send a collateral file to them, and they also put a UCC1, filed that the county against the LLC. So we couldn't sell it without paying them off. You know what I mean? Hard money lenders will use collateral assignments a lot of times. If they'll like originate a hard money loan for 150, if they're with a smaller regional bank or local bank, that bank will often give them like a 50% line of credit off of that 150, which would be another loan for 75,000. And they're filing a UCC1 to prevent them from selling that property off without getting paid. Okay. One of the ways that we do it as well, if we're using other people's money in the assignment of mortgage that gets filed, if the borrower wants to be untitled, then we'll do, say, 50% interest as a co-assignment. So if the ABC Bank is selling the note to us and our funding partner, you'll say assignment of mortgage from ABC Bank to 50% interest to John Jones IRA and 50% interest to Scott Carson LLC. Pretty simple to record. If you don't want to be on title, you don't have to be. If you've got equity in another deal, we could slap a second lien against another property. If you want to invest a little bit more money, okay, you create an LLC together with that investor. I wouldn't do it for anything less than $250, but then you could have them just invest in the LLC and give them shares of that LLC. If you've got performing notes, you could sell a chunk of your notes, your performing notes off of partials to fund the purchase of the new asset. Okay. But I usually do the co-assignment or the equity in another property, or the start a new LLC with the investor, or the investor funds my LLC and we issue them shares on that. Okay. There's a whole variety of different ways. We do go more in depth into this in the funding side of our class in day 2. Now, will a bank give me a note loan? No, they will not. Banks will not lend on notes traditionally for you, especially a non-performing note. They're definitely not going to give you a note. But like I said, smaller banks may do collateral assignments. We talked about the hard money lender giving percents. Some banks and the bigger banks, especially if it's $1 million plus note, might be willing to finance the purchase of the note on their own books if you'll bring 10, 20% of the purchase price of the note down. Some will even joint venture with you if it's a non-performing note too on the commercial property. But you've got to have the team and the experience to do that. We have done this a couple times. We've had a couple students actually use that with a portfolio. Like we got one student out of Milwaukee who bought a portfolio of some rental properties, like 29 doors. And the bank originally wanted to bring 20% down. Well, they ended up financing 100% of it on it. And then she finished the foreclosure process and then refinanced. One of our coaching students was looking at buying a hotel note, and the hedge fund that owned the hotel was willing to give him financing for both the first and the second, a long-term financing on the first and a mezzanine loan on the second for a year or two, just to get it off their books. Okay. But he had experience in this hotel and operating that and being a business owner, so they were willing to do that for him. They wouldn't let him do some just Tom, Dick, or Harry off the street. There's no experience. But bringing in 10, 20% down is a lot easier than bringing the full 100% in a lot of cases. Okay. So that's one of the advantages that commercial notes often will have more so than residential. And sometimes they'll often carry for you. What about hard money lenders? I get this question all the time. Hard money lenders won't lend on notes, even though they are creating notes. They like short-term loans, 6 to 12 months. They like control of the asset with a deed of trust, being that first lien position, which I get it. If you're buying a first lien, you're in control. I just don't seem to get it. They got to realize that they make their money on the points, the 1, 2, 3 points they charge, and then the churn, and then the flipping the note every 6 to 12 months, or the difference between what they borrow the money at 8% and what they're financing at 12%. Okay. Now they may have some notes for sale. We see hard money lenders who try to sell their notes off to recoup, give them new money to do some stuff. These can be pretty good ROIs, 8 to 12% short-term loans that if they don't, borrower doesn't perform and refinance out, a lot of these hard money lenders will come back in and take it over. But it's great if you have cheap funds. Some will have non-performing notes, but since they're usually funding these deals at 60 to 70%, they're not usually going to take that big of a discount. So something to think about if you're looking to put some money works. Now, what else do I add to funding? When I'm funding the purchase price of a note, do I have extra funded in case of expenses along the way that I don't have that money for? Yes, you do. So you always want to review and potentially pay your property tax. Now, if property taxes are paid when you check accounting, call to find out who paid them. Okay. Make sure it's the lender you're buying it from, making sure it's not like a tax lien or tax sale that's taking place. Okay. You're going to review values from a BP or qualified realtor or CMA. So that's going to cost you $100, $250 for a BPO. Make sure to always put eyes on the asset. That's an important thing. So paying somebody to go out and look at the actual property is one of the great things you want to do before closing. You're not going to do that when you're looking at the initial tape. I mean, you're going to use Google Maps to look at the property. But if your bid's accepted, then you pay somebody or have somebody go out and look at the actual asset. You don't have to go do it, okay? There's realtors and vendors out there that'll do that for you. Always want to budget in your foreclosure cost. If it's in a non-judicial state, I say what I do is figure in $1,500 for servicing costs and workouts, and then anywhere from $2,500 to $5,000 for foreclosure. $2,500 on the low side for non-judicial, $5,000 on the higher side for judicial foreclosure. And then taxes will vary, obviously, depend on state by state. Some repair costs, clean out, paint, carpet, all depends on what you find, what the property looks like. If you're buying at a cheaper price, you may want to get $5-10 grand thrown in there extra to cover some of the clean out costs. Okay, because once you foreclose, you can go get usually a hard money lender to fund on the rehab or fund on paying off your investor and rehab costs. It's a little bit different on this front end. Don't necessarily need too much extra on that aspect of things unless your investor really wants to stay through to the end. You're going to need to put insurance on the property. This can cost greatly depending on the state you're in, especially in Florida. So know what it's going to cost you for forced place insurance to insure the asset. And then other things, any utility liens, any HOA fees that need to be paid, special assessments like what's going on in Florida condos can be expensive. Look at code enforcement liens that don't go away. Sometimes they can be negotiated down, but that's what you'll find in title by pulling a title report as part of your due diligence that you may want to add to your funding. And I always throw in $500 to $1,000 in marketing costs, asset management fees. I mean, if you're looking at 20 deals to get to one deal, there's going to be some BPOs and things you paid along the way that you end up canceling your bids because you found out something. And that's what your BPOs and O&Es are for, is basically your insurance policies. And try to stay 65% of as is and fair market value when you're getting the funding. So if you're buying it at 55, hey, it's okay to go up to about 65, but I wouldn't go really farther in there unless it's a very fast foreclosure state or fast selling market. Try to stay below 70% of value of whatever your funding amount, just to make sure you're coming in at a good spot so that your investor and your funds are always protected. Now, that's different. If there's equity and you come in at 80% of the legal balance, okay, that's fine. I mean, but the equity above, at least if it sells at the foreclosure auction or you sell it for full, what you're owed, you're going to get paid it off in full. Okay. There's 5 things that are going to be protecting your ass and your investor's butt. Okay. 1, buying only first liens. I know some people don't like you talking about it, but if you're using other people's money, buying a first lien is the best way to go. Don't buy seconds, because you're always going to be behind a first lien. And if they're not paying, you're going to get wiped out. Okay. If they're paying, they're going to drag out you being able to collect on your money for a couple years. So buying only first liens are the most valuable things you can do. 2, like I said, staying below 70% of as is value. Well, what about after repair value, Scott? We don't deal in after repair value. We're as is. We're the bank. After repair is you owning the asset. Well, we're not owning the asset. We're owning the note. And yes, we foreclose. We may own the asset, but if the property sells at the foreclosure auction, guess what? ARV doesn't matter to us. You're always going to use a servicing company that's licensed to do business in the state. You're going to use attorneys that are licensed to foreclose in that state. All right. You're going to put forced place insurance on the property in case of an act of God. All right. Wipes you out, or an act of man. And you're always going to check title and collateral files. All right. If a seller is not going to send you a copy of the loan file, the collateral file, scanned copy before closing, don't close. You want to go through that and make sure all the assignments are in there, all the documents are in there that you need to foreclose. When somebody tells me, oh, we'll send you the collateral file after closing, I'll be like, hell no, you're not. I'm not closing. Too many bait and switches. All right. Question about that before we move on to the next session. Are you learning something, everybody? So this is a recap. I know that, but some of you, are you learning some new stuff on here so far? Good. Thank you, Alicia. Thank you, SK. Good. All right. Paul learned it. Wire transfers aren't that expensive. I mean, $35,000 on a $60,000 wire, a $100,000 wire, even a $15,000 wire isn't that expensive. That's just a cost of doing business. Thank you, Heather. Thank you, Hoyt. Thank you, Sandra. Thank you. Appreciate you all commenting. All right, let's move on. Finding investors, session 7. This, for some of you, may be the most valuable session or section of Note Weekend here. Okay, because I'm always amazed. I'm always surprised when I'm talking to investors, and I have this conversation probably once every couple of days with somebody, a realtor, a traditional real estate investor, or a hard money lender, somebody new to notes that have funded everything themselves or tried to get lines of credit, gone to the bank. There are tons of ways to find investors out there who have money sitting on the sidelines. Okay, now finding investors is pretty easy. I was on the phone with a guy yesterday, and we found he's in Palm Beach County. And we found 98 IRA investors in his backyard, mailing addresses, names within less than 5 minutes. Okay. Now, you can go to your real estate investment club. I would highly recommend you join your local real estate investment club, especially the first quarter of the year. They're always going to be the busiest because people want to come out and learn. Meetup groups, BNI, even going to those is a great way to go to connect with people. LinkedIn, you can jump on LinkedIn, type in note investor or IRA investor, real estate investor on LinkedIn and connect with people. Look at keywords, groups, profiles, all sorts of stuff. Easy way to find that. Okay. Connected investor website's pretty decent. Bigger Pockets is okay. A bit of a dumpster fire. There's some things that we use on both of those that make it. We've had investors raise millions of dollars on some of those websites. Okay. If you go just to Bigger Pockets, create your profile and go do a keyword search for 50K to invest, 75K to invest, you're going to see all these conversations where people go out there and say, hey, I got 50K to invest. What do I do? Well, you send that person a copy of your pitch deck video. What's a pitch deck video? It's a 10-minute video talk about what you do and what you're focused on. It's going to help you stand out from the competition dramatically. Okay. And a lot of our students are doing great stuff with that. Okay. You can also go to self-directed IRA or self-directed custodian events of networking, education, conferences even. It's a great thing to do, okay? But my favorite thing and the easiest thing that I can do from the comfort of your own home or office is we'll find investors on public records, okay? This week alone, we found 298 IRA investors who have used their self-directed IRA to fund a purchase within, it's what here? Travis County and Williamson County and another county. We have their mailing address. We get their first and last name on most of them. And we're getting ready to send out a blast to them to raise capital. You can go to Denetra Online. This is a website that's free for everybody that brings all the different county records together. Look at your state, look at the county, and then look at the first one I like is the county assessors or the county appraisal districts. Okay. Get on there and it's like search like a property search, but looking for the owner. Now, it doesn't work in every state like California or Arizona. Sorry to you, because they have privacy laws. But in most of the other states, Minnesota doesn't allow this either. Neither does Virginia or Maryland. But like Texas, Ohio, Michigan, I can go to like the appraisal district and the recorder's office and type in like Equity Trust, Quest is out of business, but Advanta, American IRA, Pensco. And I can find, it'll literally give me a list of people who have used their self-directed IRA to either A, buy a piece of property at the assessor's websites. It'll say Equity Trust for the benefit of Scott Carson. Or if I look on the clerk the recorder's office, I'll do a deed search for equity trust, and I'll find all these people who have lent money out of their IRA in a piece of property, and there's a deed filed. And that's pretty freaking simple. So we just search for the different self-directed IRA custodians. There's over 50 of them. All you gotta do is go to Google and type in ultimate list of SDIRA custodians. It'll give you 40, 50 people out there. Question here from somebody. Heather asked, do you look for the county you are located in or the county where the property is located, or both? So Heather, where are you located again? Like if you're in California, you're in Jackson Hole, Wyoming. There may not be many people in Jackson Hole, Wyoming, but if the county allows for you to search by name, yes, then you search in your name first, search in your county first. If I'm buying in Ohio, it does make sense for me to go Ohio and search in Ohio if I own real estate in Ohio. Search of the county. It's one thing that we like to do because it's an easy marketing piece. If we're buying, I'll give you an example. Like we bought a reverse mortgage up in Anderson, Indiana. It's in Marin County or Madison County. Okay. So Madison County went and found that there was 45 people who would use their IRA to buy property. So those are 45 people I added to my mailing list. And what did I do? I mailed out when that property was finished being completed. Hey, here's a new property that may be a great rental for you. I already had an investor lined up, but I also sent out another postcard and letter to him and said, hey, if you're looking to put your IRA or lazy asses to work, let's talk. And we had a few people that reached out. So yes, either or. Now, Ohio is like the land of milk and honey. It's where equity trust, the biggest one, is at. And most of the counties in Ohio, Hamilton, Lorain, I can't think of a few others out there. But you can literally go there and they'll allow you to they'll literally give you an option to download the mailing list in an Excel spreadsheet, which is pretty awesome. Okay. Some states, some counties won't let you do it, but yeah, do it in the states that you're buying in, where you live. It's always nice if it's in your local area and you can do it, because then you can meet with people locally. Okay. But search self-directed IRA company names at the county, appraisal district, equity trust, Quest, etc. is what we've used in the past. Still using. It'll often give you a mailing address. Sometimes the mailing address is the person or the investor's home address. Sometimes it's the address of the IRA company. So you're going to want to check that. Now, if it's with the IRA company and you send a mailing piece to the IRA company, they're obligated to take your mail piece, scan it, and email it to the property owner. Some will throw it away, but they're supposed to scan it and send it over. All right. What we do is, if it's in an area like here in Travis County and it says that we were supposed to mail it to like Park Row for Quest's office, we go to the county here and see, okay, does this person own any other real estate, and just do a name search by that person. If it's showing their name, if it just shows IRA number, their account number, then we'll still just send it to the IRA company. Okay. But that's the great thing about finding the appraisal districts. You got so much stuff. And it's really easy to see. If you got a name, you can search by if they own any other investment properties in the area. And the great thing, if they got a name, is going over like the LinkedIn or Facebook or Rocket Search to see if you can find their direct mail information. We pulled the list off the top 25 counties in Texas. It came to like 2,500 names or records, and we put it with our skip tracing VA, and they found emails and contact information for over 400 of them. So it's not the greatest aspect of it, but you get a higher mailing open rate from sending a postcard or letter campaign. So like I literally have a stack of envelopes right here that we're going to market and send out to. First thing I send out to is a letter campaign, okay? Or contact them on social media. If I can contact with social media, that's the easiest thing. What do you say? Hi, I saw that you bought the property with your IRA. You're looking for more deals. Love to talk. I'm a local investor, that kind of stuff. Pretty simple to do. We go through a lot of this on day 2 in our workshop. For people that have lent money on their IRA, going to the recorder's office, the clerk, same thing, searching for equity trust, Quest, whatever it might be. This is not going to give you a list that you can download. You're going to have to go and individually click on the actual deeds, copy the deeds to pull mailing addresses and full information. Okay. But what's great is you'll see often the amount lent. And if you search besides a deed, you also can search for a release of lien. These are people who have lent money, have gotten paid back. That could be potential. They've got money sitting on the sidelines to do something with. Okay. So it's an easy system to put in place with a VA to pull these lists and then do a rinse and repeat. And you don't need hundreds of thousands of IRA investors. Okay. You can buy a custom list if you want. And I'll talk about why that's pretty cool to do. But if you have, here's some numbers that people don't know about IRA investors, okay? 70% or 67, 2/3 of every person that has an IRA has 150 or grand more in it. So if you take a look at, say you pull a name of a list of 100 people, 67 of them are going to have more than 150 grand in that account. That's a lot of money. Okay. So if you send out letters, 100 letters, and you get 4 that respond, 3 are probably going to have 150 grand or more. So that 150 times 3 is what? 450. The 4th person or the other third is going to probably have less than 100. Well, that's still a sizable amount of money. All right, you send it out to 200, that's 8 people. You just raised $1 million in private capital just off of basic direct mail stats. Okay. Now, you can buy a custom list of just people that have an IRA. It's not specific to like an equity trust or a Quest or an American IRA. They just have a regular IRA account with anybody. You can actually kind of pare it down and say, okay, I'd like to buy a list of the people that have 150K or more. I don't know how they do it, but there's some of these list services that you can pare it down by city, state, county, close to you, around specific areas. You can buy a list of employees. Like when Halliburton sent everybody on leave, we bought a list of Halliburton employees in Houston to market to. Usually the list will include their name, their address, their email, their phone number. You can use Melissa data. They're okay. Exactdata.com is better. We've used them, called them up, and we have an account rep over there that we use. But when you buy a list, they're usually going to want the minimum order to be about $1,000. So if it's just a general list, like IRA investors, it's going to cost you from like 6 to 14 cents a lead, depending on how big a list you buy. If it's a business-to-business list, like the list of Halliburton employees, that's usually about 25 cents per lead. Okay. Minimum order is going to be about $1,000. Okay. So if you figure you're buying $1,000, you're paying $1,000 for leads at 14 cents a lead, that's about 16,000 plus contacts. The hardest thing for you isn't going to be to buy the list. It's to get those 16,000 names, emails, phone numbers, and addresses marketed to. Putting it into your CRM and sending out 100 or 1,000 at a time is a very difficult thing to do, especially if you're not marketing to your email list already. So this is why we talk about having a CRM is very, very important. Not only in finding deals and contacting asset managers, but also marketing for money, not just to your warm list, but also marketing to IRA investors if you want to do that. Okay. You can post your deals, stuff that you're looking for funding. We like to say post past deals from past experiences, from others, case studies, things like that. Post deals that you're currently working on. Never mention safe or guaranteed in your marketing. Those are horrible words to say. You can talk about return. Like we did a case study video just the other day on Sterling's deal. It's making 20% ROA. We can say guaranteed. The numbers make sense based on when he's buying it and what the workout plan is already signed by the borrower. But I'm not going to go up there and say, oh, you can make 20% on your deal. No. That's not the way to do it. Hey, we have an investor who's made 28% on a deal. This is how he did it. Okay. Don't say safe or guaranteed. Not a good thing to do. Talk about yield, not returns. It's about the same thing. Yeah. Okay. But you want it when you're talking about you need to be comfortable talking about you because people are going to be investing with you and the deal. They want to be able to trust you. So that's why we create this short pitch deck video for our coaching students to help them out. Is it's about you, what their focus is, their niche, your company or your team, the vendors, and the types of deals that you're looking at. This helps answer 90% of the questions and helps you mass market your business, mass market your note strategy, your note niche to people out there so that when they call you in response to getting a postcard or a letter or a connection request, they understand what you're doing and it's a smarter conversation. And you send out from the crowd. Okay. Now you want to qualify investors. Some things you want to ask. We have a one-page questionnaire we like to ask our investors. We don't ask them to fill it out. We actually will go through it with them and then ask them to sign off on it in a lot of cases. But you want to ask them, make sure, are they currently invested in real estate? Are they accredited or sophisticated? How much are they looking to invest? How long are they looking to tie that money up? Are they active or passive? All right. What have they done in the past? What kind of returns are they looking for? And that investor question helps you guide along on that. There's other questions we ask, other things. Where's the money coming from? Are you coming to get paid, once at the end or quarterly? What else? Are you in a lawsuit? There's a whole variety of different things you want to ask to qualify investors to make sure they're a good fit. Not everybody is going to be a fit. There are investors that you want to avoid, especially people unfamiliar with real estate. Okay. Don't deal with them. People wanting short term, like, oh, I want to do this in 90 days or less. Well, you're not a fit for what we're doing. Or I want to make 20% of my money. Well, then go do it yourself. You're not a fit for our passive aspect. Okay. You really want to stay above $50,000. If somebody comes to you, I got 5, 10 grand to invest, that's great. But those people are going to be more of a pain in the ass. You never want to take somebody's last 10 grand. Trust me, I know. Okay. People who talk bad about each other. In today's social media world, you want to go vet your investors just as like they're vetting you. If somebody's talking bad about Trump or Biden, or talking bad about other people, bad mouthing experiences, stuff like that, guess what? If a hiccup goes wrong in your deal or gets delayed or something like that, they're going to talk bad about you. So don't deal with those types of people, especially if they're too happy. You could give everybody, if you say 13% and you give them 12.99, they'll be upset and sue you. Okay. It just is, everything could be going along great, and something goes bad and something other deal, they're going to get mad. I want my money back. Okay. Ask for references, past partners, CPA, attorney, bankers. This is why the funding agreement is so important that you put together, that outlines these things and what happens if something goes wrong, and it will save your ass. Okay. Always paper up your deal. Always require investors to fill out the investor profile questionnaire you send them, to send you a pledge letter or email. What that means, an email with saying, hey, Scott, it was great talking to you. I've attached my proof of funds from my IRA showing I have 500 there. I'm willing to pledge 100K to you for the next 24 months on note deals. That's your proof of funds. If the seller requires it, you've got it there. But if a seller requires that before you ever look at what you've got, don't deal with them. Okay. If they won't return these items, it's like they're saying no, no, no. They can say yes, they want to work with you, but if they're not going to fill out the investor profile, you need to say, this is a requirement. I need you to send a pledge letter. This is a requirement. I need you to send a copy of where the funds are coming from. That's a requirement. So I know it's a legitimate fund. It's not a bank full of 20s and ones from the local cartel. Okay. And also, too, if the money is going to come from a self-directed IRA, but if it's not a custodian or trust that's used to working with notes or IRAs, they're not going to be able to use their Schwab account to buy a note. They're going to need to open a new account and transfer the money over. So ask that. It's important to ask. If you don't ask that question, you're going to be surprised, because it can take a week or two for closings to take place from an IRA, and then sometimes will piss sellers off. Okay. And it takes 3 business days alone to transfer money or transfer funds like mutual funds, stocks, bonds into cash. Okay. So if you're going to be using an investor to fund these deals, you've got to know where that money is at and make sure they're putting the pieces in place to be able to invest with you. This is important. Have paperwork created by the attorney. Our one-on-one coaching students will get a copy of our funding agreement. That's all that we send those out to. Okay. And by all means, we're glad to let them tweak it. All right. If you're going to send it to somebody and they want something to tweak it, it's okay to tweak it if it makes sense. But sometimes attorneys can screw stuff up too. I always will allow their accountants or attorneys to review the deal. But the thing I'm going to ask them is, like, are your accountants or attorneys doing real estate deals right now? If they don't do real estate, they're not good to ask, because they're going to say no. Okay. Always, always, always use agreements, even with family members and best friends. It outlines what happens when things go wrong. Okay. Now, here's the thing you got to realize. Most real estate investors can't make 6% or greater. So part of what I ask people is, where's this money coming from? Where is it? How long has it been sitting there? Oh, it's been sitting there for over a year. So it's making 0%. Is what you're telling me. Yeah, basically. Okay. I'll give you 8%. Well, your deal's going to make 24. Yeah, it's going to make 24, but I have to work through this. I'm going to give you 8% for not doing a damn thing. If you're not happy with that, that's probably not a fit. If you want to make 24%, then you need to go do this yourself. He or she who has the gold makes the rules. Well, the gold, ladies and gentlemen, is not the actual money. The gold is the deal. Okay? So don't go give somebody something that they can't go get themselves. Now, if somebody's getting 12% because they're doing short-term loans, then you have to give them 12%. This is why you have to ask, what are you investing in? What are you doing? Okay? Understand it. Keep that in mind. Payments and communication. If making payments, you want to make them quarterly. If they're not pulling money out of their IRA on a regular basis to live off of, or they're below retirement age, get away with putting it in there as you're getting paid. So if you're buying a non-performing note, You're not going to start making payments until either A, the borrower starts paying on time, or B, you foreclose. And if they do start paying on time, you're going to make payments quarterly, not monthly, to avoid ACH fees and stuff like that. Set up an online portal for tracking help. We use Basecamp. We've used Dropbox, Box. There's a whole lot of different ways to share and communicate with your investors. Simple Google Sheet sometimes helps as well. Okay. Never, ever, 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 ever pool investors' money together. Keep it one investor per asset. Okay. It's okay to put your money with somebody else's money to fund a deal, but don't go taking 3 different amounts from 3 different investors and pooling it together to fund one deal. That would be pooling, and that's illegal. You could have those 3 people set up an LLC and put their money in the LLC, and then you borrow money from the LLC, but that's a different story. Okay. Trust your instincts. If you've got a bad instinct about somebody, don't do the deal. Go market for more money to somebody else. And do not put off marketing for money until you need the deal or need it funding. If you've got your own funds, congratulations, that's great, but start marketing for money right now. Okay, because what's going to happen is you're going to go through your $400,000 or $500,000 or $1 million, and you're going to sit around waiting for one of those deals to close before you go do anything else, and you're missing out on deal flow. Okay, if you got to give somebody 8% on a deal and you're making 10%, you're not really making 10%, you're making infinite return on your money. So market for money. Okay. Questions about that before we move on to session 8, note marketing? All right, let's get rock and roll. Now, while last session about raising capital is one of the probably most impactful things, and one of the things that get so excited about is that you can pull lists of IRA investors from your local county at usually at no cost. The most important thing is, what the hell do I do to market my deal? Or what do I have to be doing to market my note business to get people to want to reach out to me? Okay. You got to realize 80% of sales are made after the 5th contact in anything. And by sales, that's not only you finding notes from note investors, it's also people looking to invest, looking to respond with you. You are selling your note business. So expect to post or email regularly and often. Now, these are systems, there are systems out there you can use to post. If you follow me on socials, you probably think that I sit here and have this huge team of people that post for me on a regular basis. No, I use a system like I use Keep to do my email blast out and schedule stuff. I use other services to automatically schedule videos to go out or post short videos and schedule all that stuff out so I'm not having to do it. I work with a couple of VAs that do other things for me. But this is not difficult to do, to post. Once you create some things, you can post and repost and use things like Buffer and other things to post your stuff on a regular basis. So you're not spending 20 hours a week marketing your business. You spend an hour marketing every other day, you're going to find stuff. Okay. You can automate with Buffer. Hootsuite's a little too expensive these days, but buffer.com is pretty easy. 3, the most important things to use in today's market, with it being 2025, is email. You still need this. Like keep.com is our preferred vendor. REI Black Book is also preferred as well. Okay. If you need a link to get signed up with either one of those, let me know. LinkedIn, you got to have a LinkedIn profile. If you're not going to update your LinkedIn profile, don't waste my time. Okay. If I've told you to update your profile and you're still not doing it, I don't get it. I don't understand why you won't update your profile. You have to do this. So you don't have, I haven't said you have the website. You really do need a website these days, but you can get away with it if your LinkedIn is updated. But you can use services like Octopus CRM to help automate the connection requests. You don't have to spend forever sending contacts. Video marketing of some sort is needed today. All right. And this could be you talking about the deal, or talking about notes, or talking about past case studies. YouTube is free. Facebook is free, but YouTube's going to be your best bet. And you can leverage other things like Instagram or TikTok and stuff like that. How we leverage video is recording one video and sharing it everywhere else. Okay, so it makes it pretty simple to broadcast that stuff. And there's a couple tools that we use, like Opus Clip, Restream, that make it simple for us to record the video once and then rebroadcast. Like this video alone, I am recording it through Zoom. It is already going live on YouTube at the same time with the stream. Tomorrow, we'll upload all these little short videos into one package, into Restream, and it'll rebroadcast it all out on a Sunday afternoon without me being here. It'll broadcast it to LinkedIn and Facebook and Instagram and Twitter and back on YouTube again. All right. And we'll do an email blast out to our audience who can watch that live stream who couldn't make it live today. We're hitting thousands of people on a monthly basis. Honestly, this month, I was looking at the numbers beforehand. When you look at the people that we had contact with this month who saw something of what we did. So we had just under 15,000 views on our YouTube videos. Okay, 15. We had over 45,000 views on TikTok. So that's 60,000. We had over 20,000 views on our LinkedIn profile, different posts. So that's the thing of getting out in front of people. You don't need to have a database. You can create your own database. But ladies and gentlemen, leverage the tools that are out there. Oh, TikTok was about to go away. Okay, I've got a bunch of other things that we post to connect with people. I've raised capital on all the platforms with an email and a YouTube video. All right, and posting on a regular basis. Not 20 hours, 20 times a day, once a day. This is not difficult. It doesn't all have to be about a deal. You can post about topics that are going on, case studies. There's so many great things out there. But email marketing, it's the number one ROI for marketing. It's still a 4,400% ROI. So every dollar you spend in email, you should get 44 bucks back. Okay? Yes, we get more than that back because we deliver content. We deliver something valuable to you guys. Okay? And there's a whole variety of things to send out Tuesday through Thursday emails to your database. Okay? Investor contact databases should be emailing once a week. I like Sunday evening, but sending out an email once a week to your database is important. And what do I talk about? I talk about, you can tell every month is a holiday, like February. What do we have going on in 2 weeks? Valentine's Day, Groundhog Day, right? So if you're going to send it once a week, 1 week can be about the holiday. Just wish people well. If you're going to your local real estate club or a networking event or a conference, invite people to go to that if they're local to you. Because most of you will have a local presence in your database, okay? A personal event, a holiday or an anniversary or something fun that you did, okay? And then number 4 could be about past rehab deal, throwback Tuesday, or a current deal that you're working on. It's a pretty simple formula in outreach to your database, whether it's email or social media. These are all things you can talk about, okay? And then your asset managers, you're going to be emailing 1 to 2 times a month, not weekly, but 1 to 2 times a month in marketing, okay? LinkedIn, complete your profile 100%. A good photo so people can see your face, a banner behind you on your LLC name, whatever it might be. It's literally the social media business resume. It also can act as a website if you're starting off, okay? Because that's where the asset managers are going to be. That's where the bankers are going to be. That's where the lenders will be. And people will go review your profile when you start contacting asset managers. It's easy to find investors and bankers on there. So if you're using it to leverage, to find the right contacts, you want your profile to look damn smooth, okay? We use octopuscrm.io to help us maximize connections. It's helped us cap our connections at 30,000 last year. We went from 6,000 a few years ago all the way to 30,000. It's a great tool to do it. Here's the great thing. Only 3% of LinkedIn users post on a daily basis. Most don't post once a month. More than 60% of people never email their database too. I'm not telling you to send them the latest recipe of the month like a lot of realtors do with a stupid newsletter. I'm sending something valuable. Hey, here's a deal that we're working on, or here's something that's going on in my local area, and you can segment your list by where they're located, okay? And you want to go to LinkedIn and join and post to groups too. There are great ways to talk with other people that you're not connected with, okay? And yes, LinkedIn, you can still import some of your database, your list to it to help speed up the connection requests, okay? Video marketing, I know this is where a lot of people are scared of stuff. They're not going to take the action because I don't want to do it. Guess what? YouTube is the number 2 search engine out there, owned by the number 1 search engine. You'd be stupid not to, because YouTube will actually send people to you, to your videos, if you have the correct description, the correct title, and a decent thumbnail. We use TubeBuddy to help us grow. Short videos are all the rage, 3 minutes or under, which is what most of your case studies are going to be, is being under 3 minutes. But it works 24 hours a day, 7 days a week, and 365.25 days a year advertising. And it helps you grow. How many of you are subscribed to our YouTube channel? I mean, I got 13, 14 people join me live right now on the YouTube live stream. You're probably subscribed. You probably got a notice that, hey, Scott's going live this morning. Or when I sent an email out yesterday, say, hey, you can watch live on YouTube. Why not? Okay. Share what you're doing. This is how you get the word out more. You can't be a secret agent, woman or man, and be successful. Okay. Posting to Facebook, some people like that. It's okay. Your videos on Facebook only have about a 24 to 40 hour life cycle before they get buried. And Facebook really limits to about 1 to 5% of your connections to see the video. LinkedIn Live is really working well too. You can go live on LinkedIn. That's working even better now too, that they've started to focus on short video. And smart cell phone filters. You don't have to have a lot of equipment. Your cell phone works very well to record it. Yes. What do I have? I have a microphone here, and I have an HD Logitech webcam and my phone. Those three tools are what I use for most of my stuff. Nothing fancy, less than 200. Well, my phone's more than $200, but you get what I'm saying. Using Zoom, other software to help you record and share what you're doing. Very, very helpful. Okay. Now, we always like to use something in terms of a technique we call the marketing octagon or the content octagon, the content spider. It's taking and sharing one bit of content, a video, an image of a property, a case study, and then sharing it across multiple channels pretty easy. Photos, stories do the best about a deal. We use buffer.io to share, to upload it there, or to share a photo and then schedule it across the different platforms that it'll automatically connect to. Not everyone is on every platform. That's why we share on all of them. Okay. Some people are on Facebook, some people are Twitter, some people are LinkedIn. You want to try to blast it so everybody sees it through once or twice. That's how you pay attention. I mean, think about this. We have the Super Bowl coming up here before too long. How many times are you going to see a McDonald's commercial during the Super Bowl? Or how many times are you seen football, like on football commercials, like I say, McDonald's, Papa John's, Wingstop. Okay. Think about how many times you're watching late night TV or even Netflix or Amazon, and now you're getting bombarded with drug commercials. Okay. That might help you a little bit, but then you get all these side effects. Okay. You're bombarded with these things. Bombarded. Well, I'm not telling you to bombard them, but I'm telling you to cross market. All right. Cross promote is going to equal more hits. More hits leads to more views, and posting multiple times at different times across the day works pretty well for you. It's going to get investors to say, yes, I want to invest with Heather. Yes, I like what Paul is doing. I want to find out more information. And start with one thing and then add a new thing each week. It's not difficult, ladies and gentlemen. Okay. Pretty easy to deal with. All right. Let's talk about what it takes what things you need to set up to be a note investor. Okay. There are some business structures, entities you want to put in place or be using to make sure you don't do something stupid. Okay. How do I structure my note business? Well, you're going to need to use entities. Okay. You need to have an LLC. Yes, you can use trusts. I also have an S Corp as well as kind of the parent organization. But when you're buying notes, you're going to use an LLC. Now, yes, you can use your self-directed IRA by all means, but you're going to run out of your own money. All right. So when you start using other people's money, or you don't want your name public, use an LLC. All right. And yes, it's different cost, $30 in Mississippi to $800 a year in California. I get it. If you're in California, that's your cost that's your good weather tax. It is just what it is. Okay. But use an LLC. Do not buy a note in your own name. So like if Albert comes to me and says, hey, Scott, I want to buy a note. I found a note deal, but I don't have an LLC. Can I fund it in my own name? Yes, you can, but you probably don't. The part about having LLCs and entities is for asset protection. Okay. So if that bar decides to sue Albert because he didn't follow through on something or he violated fair debt collection practices, guess what? It's going to hit him. It's an attack to him and his personal assets. If he used an LLC, though, and did something stupid inside the LLC, guess what? It's just going to be limited to that LLC, not following personally. Okay. Unless he violated the corporate veil and all that other stuff. All right. We use multiple LLCs. If somebody's going to invest $250K or more with us, we use a separate LLC just for them. Okay. If I got $1 million in assets, I'm going to, on my own stuff, I'm going to keep that in one. If I start going over $1 million, I'm putting in a second asset just for this. Like if there's a reperforming notes or rental property, something like that. Or if it's like a single commercial asset, by all means, I'm going to put that single asset in that single entity. Okay. Especially I start getting on like with a, $1 million more note, I'm definitely gonna put that in a single entity. It's worth doing that. Yes, it's going to cost you more bookkeeping wise than LLC, but it's a cost of doing business and being smart, not dumb. And as you grow in this note business, you're going to be doing different things, whether performing notes or taking property back as REOs or keeping rentals, larger assets. Maybe you start educating people and you want that separate from your real estate business. You've got an existing LLC. You want to keep that separate in something, if it's something different than real estate. Okay, yeah, you can start off, like I get loan officers and realtors that come, well, I've got an LLC. I go, okay, well, you could use that initially, but at some point, you need to move it into a separate LLC so your businesses are structured differently. Okay, it's just smart to do. Well, can I just use my self-directed IRA? Yes, you can, but still not smart to fund in your own name or IRA because you're going to have people like me tracking you down. Asset protection, something violates an IRA, guess what? It could void the whole IRA. The Consumer Financial Protection Bureau, which protects consumers when it comes to mortgages, lending, stuff like that, they don't screw around. You violate fair debt collection practices, you're going to get fined $50,000 to start off with. Okay. Some counties are suing trustees for back taxes. So, like if I use this was the thing, Equity Trust. If you're buying in Wayne County, Michigan, Wayne County, even though it's your IRA and it may say your name, they're going to sue the main trustee. They're going to sue Quest or Equity Trust for lack of back tax. Even if it's your deal and your name out there, they're going to sue the bigger company out there. So those companies usually will not let you fund in your IRA. They want you to fund an IRA LLC. And there are companies out there like American IRA, right company to use for both those. Okay. If you're working with funding or joint venture partners, by all means, use a separate LLC for them. You can use self-directed IRA LLCs, checkbook assets, makes it easier to fund stuff as well too. Trusts are not recommended when you're funding or purchasing. If you're using your own money and you want to move them to a trust, then do that. But I wouldn't do that with somebody else's stuff. Okay. You need a document. Having an LLC is not just a trip to the Secretary of State and getting a tax ID number. You need to document transactions, all sorts of different things. Your offices, your JVs, your funding agreements, vendors, partnerships, leases. There's a variety of other documents you need to document on a month or an annual basis. We highly recommend that you work with Laughlin and Associates. It's who we've been using for years to helping us with our LLCs and asset protection. They've done this for over 50 years of working with investors. About 97% of our coaching students work with them and setting up their entities and asset structuring. Okay. They're phenomenal. They have a corporate veil protection plan that will go back in your LLCs and help you document things, or setting up a new one that'll help you document going forward. Do it on a monthly basis for your documents and tracking, so it helps you sleep at night. And they have a variety of different asset stuff that they can structure for you, and teams and vendors. Plus, they host an event twice a year called Magnify Your Wealth in either San Diego or Orlando. It is well worth going to. And one of the other must-attend events like the Get Fundable Boot Camp, okay? You can go to corpveilprotection.com to find out what they're doing. It's corpveilprotection.com. Or go to laughlinusa.com. Tell them that Scott sent you. You will not be disappointed in working with them, okay? And they're even willing, the asset protection plan or the document, they're willing to work with you. So the whole fee is not due all at once. They'll work willing to finance for 12 months and actually give you some business credit with that too. Okay. Moving on. And if you are registered through the Zoom link, ladies and gentlemen, you will get the replay sent to you tomorrow. Okay. By the latest Monday, but I'm gonna try to get the replays up tonight and out tomorrow to you, probably by noon. So if you're not on the Zoom, if you're just on YouTube, go to noteweekend.com and register for this class right now so that you can get the replay videos resent to you. Okay. And the other stuff that we send out. Doesn't cost anything. Just go register. You'll be happy that you got it. Okay. Unless you want to go and watch the replays instead of watching one long video. All right. All right, let's move on here. We're going to be moving pretty fast through these next couple. This exit strategies is very important for you guys to understand, but we're on the last cusp, probably the last hour of our training today, just so you know. To give you a bit of an idea to what to expect. We're just going to run through these pretty relatively quickly because we cover so much of this in our workshop that's upcoming. But stay around, you still get valuable stuff there for you. You definitely want to stay around for the extra discount that we're going to give you on our upcoming 3-day class, okay? So exit strategies. How do you make money with these things, okay? There's 10 ways to skin a note. 10 ways to make money. Yes, there's a longer video that breaks down each of these deals. In our 3-day workshop, we're going to go through waterfall and case studies of each deal. But the first thing, yes, you can wholesale notes. You can put a note under contract and then flip that contract to another note investor. You can do that. That could be a flat fee of like $500. It could be a point. I'm flipping a portfolio of 11 performing notes, and I'm going to make a 1% fee from both the seller and the buyer. And that's based off of whatever the funding amount is, okay? If you're going to wholesale notes, you may need to do a double closing, 2 different contracts if you don't know who the seller is, okay? Never worked with them. You may want to do a separate contract so you're not disclosing who your seller is, who you're buying it from. You can also, if you trust the person, just do a signed fee agreement, turn it over. We do this a lot with our students that we knew them. I know the buyers. I'm not worried about them going around me. Okay. You're not, when you're flipping notes, you may want to use our real estate attorney to handle the incoming wire and the outgoing wires, the one to whoever the seller is from the buyer, and then one for your wholesale fee, your profit margin. Okay. And the thing is, by wholesaling, ladies and gentlemen, you're making the least amount of money, but good wholesalers know their deal and they market it. Now, why am I selling these notes? Because making 1 point on $1 million transaction is not bad. Pretty easy for me to do that when I make an introduction to somebody that I know who buys the stuff. I'm not buying that stuff, so I'd rather make the 1 point or the 2 points and not make anything at all just because I leverage my network. How do I leverage my network? With an email blast, okay? Number 2 is if it's occupied, then the borrower decides to start paying. So when you buy a note, a non-performing note, the first thing the servicing company is going to do on your behalf is reach out and ask them, hey, can you start paying again? All right. And guess what? A lot of times they just need a handout somehow. They need a little bit of get out of jail. They want to start paying on time. Now, you're going to need a licensed servicer to collect the payments. Do not collect payments on your own. They're going to send out statements. They're going to handle the paperwork. They're going to do the borrower outreach for you, okay? Now, you can instruct your servicer to do other things, like, oh, I need them to bring some skin in the game. But they're going to charge you a flat servicing fee. If it's a non-performing, it's going to be somewhere, well, every service is a little bit different, but $25 to $95 is what you're going to see. Usually it's $25 to $35 for a performing note, $95 for a non-performing, okay? And if the borrower wants to bring some extra stuff or you want to kick it down the can like a lot of lenders did during COVID, you can do a forbearance agreement. Basically, okay, you missed the last 2 years. If you start paying on time, we'll take the 2 years and push it to the back end of the loan. But if you don't pay on time, we're going to finish the foreclosure. Or if you can't pay all that's owed, you might need to modify it. Okay. And we'll do a trial payment plan. We won't do a full loan modification. I'll tell you a reason why. We'll do a trial payment plan for 6 to 12 months. Okay. You bring a lump sum or you're making your monthly payment plus extra payments. Okay. And we usually prefer 12-month trial payment plans. The reason is if it's less than 6 months or it's less than a year and you do a permanent modification, that's a short-term capital gain and you get taxed differently. Otherwise, if they're just making payments to you for 12 months, it's just treated as ordinary income and you're taxing your tax bracket, okay? But you can do a lot of things with your loan modifications. You can adjust the balance, you can forgive or reduce back payments, adjust the interest rate, adjust the payments, all sorts of stuff. Like I said, never go straight to a loan mod. Always do a trial payment plan and then go from there, okay? The borrower will need to sign the trial payment plan and or the loan modification, and your servicer will often create this or your attorney will create it for you. It's not very difficult, okay? I don't talk to my borrowers. You should not be talking to your borrowers. That's the big thing. Put with a servicer to let them do their job instead of you trying to do it around your work, okay? Now, extra number strategy number 4, if they can't make a payment or they can't, does it make sense to modify? Can they do a loan payoff? Will they pay off the loan? Can they go get a loan from their friends, okay? We'll do a reduced payoff, a settlement, like a short pay. You know, sometimes we'll stretch it out to 90 days. You pay your mortgage off in 90 days because you've got lump sums coming in, okay? Now, they're not going to usually go out and get a traditional loan on their owner occupant, but if it's a investment property, yeah, they could go get a hard money loan if there's equity. Know what they're trying to finance, where are they going to, and what type of deal it is, okay? A hard money lender is not going to do an owner occupant. That's something to think about. They might have an investor buyer do that. But this is what's important is, okay, who's going to come? I need to see a payoff letter, or I need to say a letter that they're approved to finance you or something like that, okay? Now, some people will go cash after retirement to pay off. We've seen that happen. That's fine, okay? Whatever they need to do. You're going to handle the payoff or the settlement statement through the servicer to make sure it's the right payoff amount, okay? Now, you can also allow that borrower to have somebody come assume the loan through a loan assumption program. Yes, you can allow somebody to assume the loan, take over payment subject to. Maybe a family member, a friend, maybe it's a potential investor that's coming to take it over. You need whoever's going to be making the payments, though, to fill out a new loan qualification form, because it's not an assumption if they're not giving the information who it is, okay? Because if they don't pay, then you're going to foreclose, okay? We aren't refinancing the loan. We're allowing them to take over the existing payment, so you don't need to go get a new MLOO to make them sure they're approved. You're not giving a new loan; it's an existing loan they're taking over, okay? If you modify a loan, you don't need an RMLO to do that, okay? You're not creating a new loan, you're modifying it, okay? But in a loan assumption, you're keeping the existing payments, the existing terms of the loan, so you're not changing anything, okay? Now, the borrower can always quit claim it, do a quit claim deed to the new note payer, and that happens. It's fine. It's enough to do that too. But if that new note payer doesn't pay, we're going to foreclose, okay? It's not going to stop the foreclosure if they deed it over to somebody. Short sale. You can allow that seller to sell the property on a short sale if they owe more than the property's worth, okay? Borrower sells the property at an amount below the payoff. That's where the short is, okay? But the bank has to approve the short amount. They can't just go say, oh, they're selling a property for 100 and your balance is 150. That's not going to get closed, because the title company is going to be like calling and say, hey, you owe 150. This house the contract's only for 100. So you're going to have to approve that wanted to happen, the 50K short, or the 70K short to get it to 90, whatever it might be, or 80. Okay. I always, if the seller comes to me and they want to sell the property, all right, and they owe more than they do short, say, okay, great. Let's list the property on the MLS at 85% of value. Now, I've usually bought it well below 85. Okay. And we're going to look at the first 2 weeks. If there's no showings in the first 2 weeks of the property, that means it's a slower market. It doesn't make any sense. Now, we're not going to allow the borrower for showings to appear around their schedule. It's going to be any time somebody can come over and view the property. It's like that, okay? Because otherwise, borrowers will play shenanigans. I used to do a short sale negotiation company. I know all the shenanigans out there, all right? If they don't have a realtor friend, you get a realtor to go over and meet on their behalf. Also, you can reduce the commissions. If everybody's going to bleed, if you're going to bleed, everybody's going to bleed. So I'll reduce commissions to 4 or 5% for both parties. Instead of 3-3, it'll be 4, so each gets 2-2 if we're taking a short. Okay. Now, if it's the same agent, 4% is not bad. But if it's 2 agents, they might give you a bit of a burr about it. I'm like, well, look, sell it in less than 30 days. I'll bump it up to 6. Okay. But if there's no showings in 2 weeks, then we'll move to what's called a deed in lieu or cash for keys or consent to judgment to expedite the foreclosure. And if the borrower is a real pain in the ass, you can 1099 that borrower for what is shorted you write off. Okay. That's a hidden tax strategy that you can do if you're taking a loss on property. 1099 the borrower for what you're taking a loss on. They can go write it off their taxes by showing to be insolvent, and you can write it off your profits as well. Okay. 7 is deed in lieu, cash for keys. That's a deed in lieu of foreclosure. This is letting the borrower walk free, scot-free. They're walking away from their loan. They're deeding the property to you to avoid the foreclosure. You may be giving them some cash to avoid the foreclosure to expedite this, okay? Where the borrower deeds the property back to the bank, you, the bank, are then going to file a release of lien. And now once the deed is actually signed, not recorded, from the time that the deed is signed over to you, you are the owner of that property. You're responsible for the taxes, the maintenance, and the stuff like that, okay? Now, it is a forgiveness of debt. So one of the things you have to make sure is that there's not a second mortgage on the property. Because if you take a deed in lieu and there's a first and a second, guess what? That second now falls into the first lien position because you've basically forgiven the first. So if there is a second, you would not do a deed in lieu. You would either call the second and negotiate to buy that second at a discount, or do what's called a consent to judgment. The borrower is agreeing to the judgment. This allows you to take that in front of a judge or finish the foreclosure to wipe out the second, okay? We do cash for keys anywhere from $500 to $10,000. I know one student's doing a cash for keys right now for 75 grand because there's that much equity in the deal, and they're doing it to actually make more money by taking the property back. And the borrower's old and elderly. They were fine. If they would have listed the property, they probably could have sold it, but she didn't want to sell it that way. She'd just rather get her money and move on. And it's instead of being a 90-day process, it was a 2-week process. Okay. Borrower's got it clean swept. She'll be moving out of the property. That's what we always ask. If you're going to do this, you're going to get $500 to sign, and you'll get the other money when you're out of the property. But the property's got to be clean, swept, and it allows for you to avoid a devastating foreclosure on your credit that's going to affect you for 7 years. Late pays, 24 months. Foreclosure, 7 years. Okay. Like I said, pull title, make sure there's no liens on the property above yours. A weed lien where you've got to pay to have to pay the city where they came out and mowed the grass. That's okay. That won't go away. Tax liens will not go away. Those got to be paid. All right. But if there is lien, get a consent to judgment, and you can give them cash to consent to the judgment as well. All right. But always pull title and take internal photos. Make sure your realtor goes over there and takes photos. Make sure the current realtor is active. If the current realtor will not respond to you, you're going to fire their ass and finish the foreclosure. Okay. Realtors screw this up all the time with short sales, is they'll list it for the full value because they're greedy. Okay. They don't understand that listing at full value is not going to drive any type of engagement to it, especially if it's listed third-party approval needed. You need to incentivize buyers to come take a look to get this little bit of extra equity. Now, with the market being like it is, you may want to list it at 80 to get a multiple offer situation so that people are bidding it up to 85, 90, so it's a less short for your part. Okay. But you doing a short sale should not take 6 months. Okay. We do them in like 24 hours. Okay. We're going to do a short sale. Great. You got an offer. When can they close? 30, 45 days. Let's get it done. Okay. You can also, if you don't like, Hans got a question from somebody probably about short sales. Nope, SK, that's on your side. It's got to be on your side. Refresh the video stream and probably save it for yourself because we're sharing. Yeah, we're still sharing. Everything's fine on our end. Refresh your stream is what you need to do. Maybe the video is stopped, but you're getting the audio. Okay. 8, you can allow, if you buy in a note and you bought it at a discount, and you don't want to go through a foreclosure, you want to evict somebody or something like that, whatever, you can always sell it to another investor. You've technically created value already by knowing which way the exit strategy will go. We're not talking wholesale. You've closed on the note, you've purchased the note, and you're selling the note to somebody else. Maybe the borrower filed a BK Chapter 13. You bought it at 60, you can sell it at 70 now. Okay. Or the borrower started making some payments on time and I need to offload this. I'm going to sell it to somebody at a quick profit. Okay. If you've worked out and you see, it's a longer foreclosure time frame. I know the borrower's moved out of the property. They're no longer in it. We're going to go through the foreclosure process. That has some value in knowing the exit strategy and that stuff. Okay. Many funds will buy notes, buy portfolio of notes, work to modify in 90 days with the borrowers. If whatever notes they're not successful, then they look to move those assets to other note sellers at a 10% or greater purchase price. So if they make 10% on their money in 90 days, that's a 40% annualized return. They churn, modifies, cash flow will keep. Once we don't want to foreclose on, we'll start the foreclosure process, but we'll look to sell these at 10, 15% profit and make a good ROI and move on to the next one. Okay. You can always usually sell to local investors, market via the local meetup groups. The big thing about like marketing on like Craigslist or a ReClub is understanding that they're buying the note, not the property. That's the biggest thing you're going to struggle with. Okay. Understand that. Handyman special needs some work. Finish the foreclosure. This works pretty well in faster foreclosure states, but if it's a longer foreclosure state, it may take a while unless people understand it or the foreclosure is almost done. Okay. It's important to find an investor-friendly realtor. Many of them will understand if they've got investors out there, they'll understand that they can pick this deal up as at the discount, and it makes sense for them to do it. Okay, but they've got to bring money on their funding side. They're not going to go get a loan from the bank to buy your note deal. So that's an important thing to talking about if you're talking like handyman specials and other buyers. Okay, 9 is just what's going to happen. It's called foreclosure. We talked about this a little bit on the front end. Non-judicial. It's a faster, cheaper, starts at about $1,000 in Texas here for the fastest foreclosures. Judicial, go through the court process. Starts at like $2,500 and up. You're going to pay a retainer of like $1,000, $1,500 to an attorney to do that, and go that process route. If the borrower doesn't come to the table, doesn't pay you off, you don't do a short sale, don't do a deed in lieu, then guess what? You're going to sell it to the foreclosure auction. And the attorney is going to ask you what you want your bidding instructions to be. Me, if I think it's going to sell, I might say, okay, especially if there's a ton of equity above it, I may say, okay, opening bid be the full value. But I prefer to make my opening bid. I mean, the attorney's always going to start like at $100, okay? But my maximum bid might be 80 to 90% of the debt if there is equity, or 85% of the value of the property if I can get someone to bid up that. Because if I can get 85, 90 cents from a foreclosure auction, woo, and there's no equity missing out on, that's a good day. Now I get a check in 30 days. And I ain't got to remarket the property. I ain't got to put money into rehabbing it, into paying closing costs and commissions. It'd be done in 6 months instead of taking a year to market and rehab it. It makes sense. So know your asset. Okay. If you don't sell it, or you want to take the property back for full legal, then make it your full payoff. And if you want to hold it, take it back, turn it into an REO, do whatever the heck you want with it. It's fine. But the foreclosure is going to wipe out any liens behind yours, seconds, juniors. Not going to wipe out tax liens. In some cities, some states, it will not wipe out water liens. Those things kind of follow the property of the borrower. Okay. If you take a property back, make sure you slap a lien on the property, securing your investment or your investor's money, and over encumber the property. There are charlatans out there who track foreclosure sales, who go slap on fraudulent liens like $8,000, $10,000 on a deal, hoping you'll pay them off faster than waiting the 90 days to get a fraudulent lien removed. Okay. So you slap a lien on a property for your equity and above it, so that if it does, you can wipe it out with a friendly foreclosure. Okay. This is something you should do on your rental properties too. Don't leave all your equity free and clear on a property, because there's people who will slap mechanics liens and other things on just for the fun of it. Okay. Number 10 is selling the reperforming note. If you bought the note and it's now performing, that means the borrower's paid on time, brought some skin in the game on the front end or monthly, and made at least 6 months of payments or 12 months of payments to refer. That's considered a reperforming note. You want to get the most value on a reperforming note, you really need to be with a third-party servicing who's tracking payments, can show all the payments, where that all went to, call logs, all that good stuff. And if it's a modified payment where the borrower is making a modified payment, it's not a permanent payment, or they're paying $500 a month, their normal payment plus $200, you're not going to sell off the $200 extra. You can really only sell it off the P&I payment of what's coming in. Okay. And not off the full legal balance on the reperforming. You're going to sell it off the UPB. Okay. That legal is going to be the bonus they get for collecting on it. Okay. Now the borrower may still be behind, but it's paid 6 to 12 months straight. And then you can decide to do a forbearance on the back payments, or just allow them to pay that off a little bit. It's up to you. Okay. Now 11 is a bonus strategy is bankruptcy loans. BK loans. Borrower's got to file bankruptcy. They got to file that 9-page report with a BK attorney. You're going to need a bankruptcy attorney through your servicer to collect. Oftentimes your servicers will have somebody in that state. It's a little extra cost, but it can be kind of beneficial. In a BK Chapter 13, it's a restructuring. So they're going to be paying their existing payment on time plus extra to get caught up in 5 years. So that's the great thing, is that a borrower, when they file BK, they have to submit this 9-page report that talks about all their costs, their debts, their retirement accounts, and they have to submit a plan to get caught back up within 5 years. Okay. So a BK Chapter 13 is often going to turn into a performing note where they're paying the existing P&I payment plus extra. All right. That's what they should do. Now, if the extra they're paying isn't much, like say, does it make sense to do that? You can cancel and say, no, we deny your payment plan, and they can get kicked out in a lot of cases. If they agree to the pay and they stop paying, you can get it dismissed and then finish the foreclosure. But it becomes basically a 5-year payment stream. You have the right to not approve the payment plan if it's bad. And it's actually BK Chapter 13 loans are sought pretty highly after, and they'll, by some firms, Wall Street companies, who'll pay 80 to 90% of the UPB a lot of times. So it can be a pretty good deal. Like I said, the payment plan doesn't fall through, you can discharge it, kick it out, and then restart the foreclosure process. BK Chapter 7, though, is a debt liquidation. That doesn't mean that your mortgage goes away. It means that they have basically to sell the property. So the family doesn't get to keep the house. It becomes basically an REO after you foreclose. But it's like, listen, you got to move out, you're liquidating, you don't get to keep the house free and clear. You may have to evict them, and that's will vary by state, but we will, if somebody files, is looking to file Chapter 7, like, okay, we'll do a deed in lieu of foreclosure or a consent to judgment, but you need to get the heck out of the property. If you're not gonna comply, we're just gonna finish the foreclosure, and we'll petition the court, the bankruptcy court, to allow us to do that. Right? A lot of stuff. Exit strategies, I know, vary a little bit. It's like a choose your own adventure sometimes, but you'll learn. We go through a lot of that in day 3 of the workshop upcoming. Okay. Let's move on. All right. When you buy a list of notes or you're looking at a list of notes, it's important to understand, is it a deal or a dud? Okay. There are things to consider before buying. This is not meant to scare you. These are just simple things that I put out there that I just didn't see on people's, like other people's due diligence spreadsheet, that you have to kind of keep in mind. And if you don't know these things, some of these might be common sense. Others like, oh, I didn't think about that. All right. Look at the servicing notes. When you're buying a non-performing note, if it's with a servicing company, it's why we require that. There's going to be notes. There are going to be conversations back and forth between the servicing company and the borrower. There's going to be attorney notes as well. So you want to look at that. See what's going on, because that'll tell you if the borrower is friendly or a pain in the ass. Okay. Look at the payment history. Were they on time for a while? What happened for them to fall behind? You know, one of the big things I look at is, okay, were they behind before COVID? If they were behind before COVID, they had every chance in the world to get back on track during COVID, right? So I know if they've had every chance they didn't fall through that, I'm going to foreclose. Okay. Now, why lenders don't do that? Some lenders don't do it because they focus on other things. Some focus on bigger assets. Some they like one specific niche. They don't like to focus on non-performing. It just leaves them, it gives you opportunity. Okay. But if they were current before COVID and they defaulted during COVID, okay, it's not so bad. We'll give them a chance to get back on track. But we're going to look at the servicing notes to determine that. What happened? What's the cause? Did grandma get run over by a reindeer? All that good stuff. You know what I mean? All right. We're going to look at the market values. Is the market value going up? Is it going down? What's going on in that market? Days on market. Okay. If is it greater than 90 days to sell a property based on our BPO, a broker price opinion we got, then we're going to reduce our bid. Does it need a lot of repairs? Okay. Is the as-is value lower than the repaired value? Now, we're not dealing with after repair value, but if they just pulled a Zillow valuation and the property's not in good condition, I'm going to make sure and reduce my bid if it needs a lot of repairs or in bad condition. Of course, your foreclosure time frame will vary state by state. It also varies on where they're at. You know, Florida's got about a year foreclosure time frame. Well, you got to keep it. Well, are they like 90 days from the foreclosure auction? Well, that's not so bad. Okay. Keep that in mind. Look at what's going on in the neighborhood variables. Is it right next to malls? Is it right next to a train station? Is it in a drug area? Is it next to a homeless hotel? All things in the neighborhood you want to take a look at. Zoning violation issues. Now, a lot of these things you will not get till you've actually made an offer. Okay, but these things will help you reduce your bid, that you things you want to consider and look at during your due diligence period, which may be 7 days, it may be 30 days. It just varies on who you're buying from and how many you're buying. Look at zoning violation issues. You'll see that on title. There's this, call the zoning department, see what's going on. City government issues. This is like Crook County. All right. Crook County is horrible with their city government. If you don't live there and you're an outside investor, they're always going to side with the local voter. It is what it is. Okay. Look at the crime map. Is it in the good areas or the bad area? Look at the size and population of the city. Just because the numbers look good, but if it's only a city of like 800 people, unless that 800 people is right outside a major city, then don't buy. If it's out in the middle of West Texas and there's nobody around for miles and miles and miles of Texas, don't buy it. Okay. Look at the exterior condition. You know, are there toys in the yard? Is the grass mowed? Is there mail stacking up? Is there a notice in the window? Look at the rural location too. Rural, like I said before, may not be a bad thing. It may be a good thing, but it also may be a bad thing if it's nobody's bought it for years or looked at it. Okay. I always like to buy in cities that have local colleges. Worst case, if I have to take a property back and there's a college nearby, I could probably rent it as a rental for a period of time. Okay. Does the asset meet your strategy? This is important. You always want to try to get cash flow from an asset. All right. unless it's vacant, you're not going to get cash flow. Then you look for a deed in lieu or foreclosure. Okay. But number one is we want to try to get cash flow with it becoming performing or reperforming. If it's not occupied, then we can look to get large checks with either deed in lieu of foreclosure, we can turn around and sell it, or foreclosing on it as an REO sale. Now, if you want to go number three, asset growth with taking it back and keeping it as a rental or doing a note origination, you can. I don't like those exit strategies. It's not my favorite. It ties up the equity too much when I can turn that equity and increase the value and the velocity to make higher returns. Okay. You want to avoid weird assets and unfinished projects. Like, don't buy an unfinished building. Okay. Don't buy a building that looks good, but it's just studs on the inside. That's not a smart play to make. Okay. Does asset have three profitable strategies? Those three profitable strategies would be A, get it reperforming. If they start paying on time again, is this going to make sense? Right. Two, if they don't pay, can I get a deed in lieu or cash for keys? And is it going to make sense to do that? Yes. Three, if we have to foreclose, is it going to be a profitable return if we foreclose and have to go through the full foreclosure process? Yes. D&E, turning a rental, or new note origination. Some people do that. It just, numbers don't work on that. If you're going to turn into a new note sale, then you need to hold on to it for 90 days. Or rental, you need to hold on to it for 90 days. And then it makes sense if you can do a cash out refi, pull your equity out of the deal, and then leverage it and take that money and go do something else with it. Okay. But if your money's going to be tied up on it, just sell the property. Just get it in, flip it, wait a year and 1 day to sell it. So it's a short term, so it's a long-term capital gain versus a short term. Okay. Always got to require and see, has the legal started? Where are they in the foreclosure process? Ask to speak to the attorney. Some sellers or servicers don't want you to do that. Well, then send me the legal notes. Okay. Where are the hardship letters? Is there any background of the borrower? You'll get a lot of information in a copy of the collateral file. If it's filed bankruptcy, ask to see a copy of the PACER report or go to the BK courts and download that. Review, this is a big thing, as some of these notes we've seen haven't been paid on in 6 to 10 years in some cases. You need to review each state's statute of limitations for debt collection on mortgages. Like, I get tapes in where people haven't paid in 6, 7, 8 years. Well, if I see that they haven't paid in, like, say, 10 years, like I think Pennsylvania's statute of limitations is 6 years. Well, 5 or 6 years. But if they haven't paid in 10 years, I can't collect on all 10 years of the back payments. I can only collect on the most recent 5. So if a seller says the legal balance is this amount, like, well, no, your statute of limitations, it reduces that number by a quarter. So I'm making my bid off of that. So that's something to keep in mind as far as statute of limitations. Now, there's ways to get around that we share during our 3-day class. Okay. In states like Florida, Colorado, New York, or Nevada, there's something called safe harbor, that if you're buying the note and foreclosing and there's a huge HOA fee, you kind of wipe that out. I mean, you don't necessarily, it all goes away, but you're going to pay either the balance of 1 year's of HOA fees or 1% of the original sales price of the asset. So keep that in mind. That's a great thing in Florida with HOAs. Now, condo associations, similar. I can't remember the special assessment. No, special assessments would be the lesser of the 1 year or the 1%. Okay. But that's something definitely keep in mind looking at condos. Now, that doesn't work in all states. Like here in Texas, the HOA fees, condo association fees don't go away. So you got to keep them, may have a balance to pay on those. Okay. All right. Let's move on to session 12. We're going to get to the due diligence aspect of note investing. How do you evaluate the deals? We're going to talk about some of the things to do. There's a lot to due diligence. I'm sorry, you're going to be doing due diligence on several things. You're going to order some things to help you with due diligence. There's 2 phases of due diligence. Let me just get into it and share it with you, okay? You're doing due diligence on the borrower, property, and the collateral, okay? We had a longer due diligence video at this video link. We spent a lot of time on due diligence on day 2 of our workshop. But the borrower due diligence, you're going to look at servicing notes, responsibus, has this servicing company a right party contact, what caused the trouble to begin with. You're going to look at the loan documents, the 1003 loan application or the financial documents, any hardship letters. You look at the PACER report. I will even go to white pages or Spokey.com to find current phone numbers and address. Now, you can't call the borrower and talk about, oh, I'm buying your note and modify. Can't do that. It's a violation. You get in trouble for that. But you can't have a realtor call to see about trying to buy the property or if they're interested in selling the property. Okay. Look at a borrower's social media. I mean, we've seen things on social media where the borrower said, "Oh, we're going to go to Disney this week instead of paying our mortgage," or "I broke my leg, I'm out of work for 3 months." Okay. Or "I'm getting breast implants, instead of paying, I'm gonna be an exotic dancer." Okay. Whatever. It happens. All right. But it can tell you a lot about what's going on at the bar. And it's always worth doing to see if you can find anything about it. Okay. Also, sometimes you can find neighbors and family members who are posting online and see who's around. Okay. When I was buying a lot of apartment loans, I was actually doing a white pages search for the property address, and I would find phone numbers of tenants. And I'd call the tenant and say, "Hey, I'm trying to track down your management. Can you share a number for the management's office? And what would you do differently if you owned the property?" And I'd get all sorts of details. Oh, there's gangs, there's crime. Oh, it's a great place, all that good stuff. Okay. And even look at past or present employers. This was kind of became important, obviously, during COVID. Are they working? Are they not working? What do they do in the past? Were they a mortgage broker? Were they a financial advisor? I mean, we bought a note before on a guy who was a vice president for Bank of America that hadn't paid their mortgage. Actually, they lived in Modesto, California, now that I think about it. Because the collateral file, we got their driver's license. It was pretty easy to Google the guy's name and found out he was still working at B of A, but wasn't paying his mortgage. Okay. Not good. Moving on. The property. Obviously, this is kind of a no-brainer. The property, obviously, look at the values. Online values, you have to trust Zillow or Google, or sorry, Zillow or Trulia for values. Google Maps, you kind of get an idea that can just look at especially if you look at Google Maps, look at the date of the photo. And you're going off of as is, or the values, what it is versus a 30-day sale price. Now, sometimes too, a 30-day quick sale price is different. It's going to be less than the as is value. So keep that in mind as it's based on days of market. Look at the exterior condition. Does it need a new roof? Does it need a new paint job? Is the grass not mowed? Are there toys out in the front yard? Is there landscaping? Look at the days on market conditions. Is there a ton of inventory? And look at your competitors. Always put eyes on the asset before funding, sending out a realtor, sending out somebody to do an external BPO for you, a drive-by. Not two guns, but a drive-by to make sure that it's actually there and not trashed or gone. Okay. Always pull nearby sales and comps of the property. You're going to do that by either paying for a broker price opinion from like a BPO company like Baldwin Advisory Group, or you're going to hire an attorney, hire a realtor to pull a CMA or comparative market analysis for you. Check the taxes owed and any pending tax sales. Call the tax office. Hey, I see there's a balance owed. Are there any pending tax sales on this asset or any workout plans that I know about? You'd be surprised at what kind of information they'll share with you. Look at code enforcement liens, neighborhood activity. See if it was previously listed on MLS or rental postings. That's worked well for us to see the interior of the property, know the values and condition. Okay. Look at rent rates. Does that make sense? Is it a good rental market? Is it a bad rental market compared to other things? Try to find, when you're looking at buying this, try to get a copy of the HOA, the COA limitations. Especially in Florida, you have these 55 plus communities where you can't actually rent the property, or you've got to age restrictions or stuff like that. Okay. Look for special assessments especially on condos and things like that. What's that special assessment? Right now, there are a lot of special assessments that are killing deals in Florida. Okay. Look at the crime map. Is it near some crime? Is it away? Is it going through a regentrification of the neighborhood? That all comes to bear on the true property value if you want to own something. Never buy a note on a property you don't want to end up owning. Okay. More of the property, you will not get internal access most of the time. Reverse mortgages, you'll often get internal property inspection by HUD. Okay. If a seller is advertising the sale of reverse mortgages and they will not share that, I just don't buy it. I'm like, listen, every other true seller of HUD is giving internal inspection reports review. If you're not going to share that, I'm not going to waste my time putting an offer in. Okay. Use Zillow values or Trulia for upfront due diligence. Pay for somebody to go out once you get that note under contract. Okay. You can leverage realtors with online AVMs by going through narrpr.com. It's a free AVM tool. It's good for realtors, but on the front end. I had one realtor, I'll do an RPR report for you over all over the state of Florida. So, well, that doesn't help me. But what do you mean? I need somebody to be my eyes and ears across Florida. I need somebody to drive. That means I'm buying from like Miami up to Jacksonville, or from Marco Island up to Tampa. Okay. NAR RPR is just going to go off sales. It's not going to really show a lot of distress stuff. Okay. Call the utility departments for more information to see if the power is on, to see if electric is on the property, if water, if there's no water or electric, when was it turned off? That tells you a lot about the interior report. And you find out as you're going through due diligence that it's trashed out or there's a mold issue or stuff like that, you can always fade, reduce your bid if the value comes back low. If there's internal problems like with mold that you didn't see and you close on, that's why you get forced place insurance to protect your ass in case something like that happened that you couldn't see. If you couldn't get into your inspection report or couldn't see inside, guess what? You'll file a claim and it solves it. But always put eyes on the asset. So important to do. The collateral, which is the loan file, that's the due diligence on that. You want to make sure that they have a copy of the original loan documents and or mortgage. You want to make sure that the chain of assignment is recorded, or at least in the collateral file. So if the note's been sold 3 or 4 times, you need to make sure that there's 3 assignment of mortgages and 3 allonges along with it that go along with the assignment of mortgages. The assignments are filed to the county. The allonges are not. Okay. Check for the deed of trust. Make sure the name matches up with on the loan file, as in who owns the property. If there's a previous appraisal, great. Take a look at that. That will often have interior photos that you can look at. Look at the borrower's 1003 loan application. Make sure it matches up. Make sure it's Dodd-Frank compliant. It was owner finance note. Okay. You're not going to get the actual physical file till after closing. So a soft collateral file is just a PDF scan sent to you. But look at the date of the PDF scan. If the PDF scan is 2 years old, well, I guess there's probably more documents have been added to that collateral file, tax documents, statements. I have bought notes. When I got the collateral file, there was signed deed in lieu sitting on the front. There's an insurance check that needed to be cashed that wasn't cashed. These are all valuable things that work in my favor of doing that. And so when I buy a note and the collateral file shows up, I take my time to go through it and rescan it. Okay. But that's honestly, insurance is going to help you. Your due diligence, pulling a BPO and an O&E after your bid's accepted. Those things are insurance that help you making sure it's a good deal. Okay. Now your vendors are very important. Any questions before we dive into the vendor aspect of things? The great thing about note investing is it's not all you, ladies and gentlemen. It is a very vendor-driven business. They all get paid, but you rely on your vendors more so than anything else. And that's what credibility with buying notes. It's actually easier than credibility, like going out and doing rentals and flips, stuff like that. You've got to be really hands-on with doing fix and flips or doing rentals. We can agree to that, or have a property manager do that. What you're paying a servicing company to service or be property manager of your payments or your attorney fees is so much easier than dealing with toilet stands and trash outs and vacancy and stuff like that. Okay. But you're going to use your trusted team is going to include your servicing company. You may have 2 or 3 different servicing companies. You know, if you're buying a note from a seller, some servicing companies want to have a minimum like 5,000 or a 50 note portfolio for you to be with them. You don't want that. You want to move it to somebody else that allows you to start off with one-offs. Okay. I had one servicing company we were buying, like BSI requires you to have a $5,000 minimum servicing payment each month. Well, that doesn't make sense for me. We moved it out. Okay. Madison Management's okay. Allied's pretty cool. Covey Financial is good for performing. They're no longer accepting non-performing notes. Covey is, and they actually prefer to have a portfolio, growing portfolio. They're not going to be a really good source for you if you've got a one-off note. Okay. Essence Servicing, they're not so bad for new investors, but they're more expensive than others. Okay. You're going to need a company that can pull O&E reports, not title reports, O&E reports. Okay. So there are some companies out there that you can buy an individual O&E report for $100. Okay. And we'll give you a couple. Baldwin Advisory Group is one that we use to order O&E reports. You can also use Pro Title USA. Pro Title's not bad. Pro Title does a lot of the FHA big portfolios. They also use AI a little bit more so in their stuff. And so it's not been bad, but there's also been some times that Pro Title's missed some things. You're also going to need, like I said, to pull a BPO, a drive-by, a property inspection. You can use Baldwin Advisory Group straight from their website and order most of the stuff. You're going to need foreclosure attorneys to help you with the foreclosures in each state. Servicing companies will often have their own list. You can go to Legal League 100 if they don't have somebody in the area that you want. You can find somebody on there, or you can take a referral. If you're using an existing attorney in an area, use them. Just have them go register with a servicing company, and it's the easier thing. Okay. Special servicing company. If you're going to buy a lot of non-performing notes, you probably want to hire a special servicing company to do more active borrower outreach. Okay. We've got a special servicing company that we use when we're buying non-performing to do a lot of aggressive stuff. Now, they want to work with you. They want to have a minimum of 100 loans, okay, to make it worth their time and being aggressive. There are some other smaller servicers out there that'll take a piece of the pie and working to get your borrower back on track. We've got somebody in-house that does a lot of our special servicing for us because she used to work for a servicing company and understands that. So it's well worth what we pay her as part of our staff to basically do borrower outreach. Okay. You can also, like Singer Law Group used to be a company out there. Daniel Singer, I think he still does it to help investors. He's merged his practice with somebody else just recently out in California. But there are some other aggressive loan workout companies to help out with that as well. If you need somebody, let us know. We're glad to help you out with that. Your Trusted T Continue, you're going to need a collateral review and storage company if you're buying a lot of notes, especially if you're traveling a lot. If your collateral is really the most valuable thing. So when you start, servicing companies will hold this, or collateral storage companies will charge you a per file fee per year. Sometimes it makes sense. Other times, if you're foreclosing, you may just want to put it with your attorney on the file. I have them sent to me, and we have a storage locker on the 5th floor of a storage company, and it holds all our files. It was cheaper for me to pay that the $100 or $200 a month we pay them versus 1,000 notes being stored somewhere else. Okay. Now they will review, these collateral review companies will go through and tell you what's missing. Like Joel Markovitz, our buddy out of Irvine, he'll go through these and tell you what's missing. CSC is a company out of Dallas. They'll do the same thing. Richmond Monroe is a company out of West Branch, Missouri. Will store your file. They'll tell you what's missing and then help you collect it. Joe will just tell you what's missing and point you in the right direction. CSC will do both, tell you what's missing and help you out with that. Okay. Realtors, you need realtors to pull values, to list your properties, to be the MLS contact there for you. Realtor.com, ActiveRain.com is kind of outdated a little bit, but Realtor.com has been a great source for it. Baldwin Advisory Group also has a nationwide realtor network that's going to help you be your listing agent as well. His wife, Belinda, has a lot of network stuff like that and some back channels to other realtors across the country. Okay. Property insurance company, you want to use a company like Ross Diversified, National REI Group, US Risk, Lloyd's of London to give you forced place insurance. Now, what happens a lot of times is that with your forced place insurance, your servicing company can offer that through their vendor on like a blanket policy on your individual note. So check with your servicer what they charge for forced place insurance. Oftentimes that will be, if you're going to advance it, you're going to pay that, it's going to be added to the bill for your borrower and either reimbursed, or you're just going to get paid that as a lender advanced fee at foreclosure. Becomes part of your legal balance. If you're dealing with vacant properties, you want to get a property preservation team. You need realtors for that. Baldwin Advisory Group also has a couple of companies across the country that'll do that for you. And check out more about Baldwin Advisory Group. Dickie Baldwin has been around in the industry for 40 plus years for a variety of stuff. Great guy. BaldwinAdvisoryGroup.com. Reach out to him. He just recently he's gone through some surgery and is getting back on track, but doing a great thing. If you have an issue, can't get a hold of him, let me know. I can reach out or give you our alternative vendors in our referral network for you. Okay. Question. All right. Questions about vendors and your team before we talk about what comes next? All right, moving on. So Note Weekend, or this one-day class, Note Investing 101, is meant to be kind of the Cliff Notes version. Yes, we went through a ton of stuff in the last 3.5 hours. But what comes next? If you really want to dive into note investing, there's a couple things that you can take advantage of going forward for you, okay? And we offer some different things. So the first thing we have, especially upcoming in 2 weeks, we have our next workshop, Note Buying for Dummies. If you go to notebuyingfordummies.com, you can register there. It's a 3-day workshop. It's a Friday, Saturday, Sunday. All right. We do these in two different phases. We do them online virtually, and we all do them in person. We do it. We haven't done an in-person class in a while, so people wanted to come to Austin. They want to spend 3 days in here and network with other people. So people learn a little better in person. Well, guess what? We've got that class for you. It's February 14th, 15th, and 16th. It's a different price for the in-person class than the virtual. Okay. Just because there's more costs, there's more overhead, printing and other things, whereas a virtual class is pretty easy to do, right? But give you a bit of an idea of some of the success that's come from our classes, from our students, just in the last year plus, okay? John and Veronica Gore have closed on 20 note deals, and their portfolio is averaging over 22%. All right? All right. Cal Ewing is out of Canada. He's bought 12 notes, 7 performing, 4 non-performing, and he's getting his first deed in lieu, which is going to be over a 6-figure profit to him on that deal. It's actually here in Texas, and we're helping him with that deal. Phil Brodeur, another Canadian, has bought 14 notes, 10 performing, 4 non-performing. He's got one. It's going to be a $50K profit, the foreclosure auction here in the next week or two. Larry Hoffman's been around for a while, 50+ notes, making 6 figures. Catherine Bell, been around for a while, 20+ notes, 6+ figures. Keith Holland, started off full-time, but he's also a very active real estate investor in Little Rock. He bought 4 notes with us, 3 performing, 1 non-performing that resulted back what he paid for the asset and profit. And he also took what we learned to raise, a couple $1 million in private capital to fund a hotel purchase. Okay. Paul Riley bought 8 performing notes, seeing a 12%+ ROI to him. That's on top of what he's paying in private capital. D. Armstrong's bought a note for $20K. Okay. Sterling James, our newest one-on-one coaching student, just closed on his first deal. He's only been around for 90 days. And that 1 note deal is making a 20% cash return to him, tax-free in his Roth IRA. And we just did a podcast episode on it. If you check it out, the Note Closer Show, or go to our YouTube channel, you'll see me talk about specifics about the deal, the numbers, how we found it, how long it took to close. It should have closed in 30 days, but with the holidays and everything, it took 45 days, but still a good deal. That's the great thing I love, ladies and gentlemen. I'm so proud of the fact that our students close deals. We close notes, not we talk notes, okay? Or Scott talks notes, or Scott funds notes. No, our students go close notes. We've taught thousands of people, and we're really, really proud of the fact that our students have probably closed more note deals than others have. Because I can rattle off a list of names. People have closed 100, 200, 300 notes over the years from being a part of our class and part of our coaching. Okay. Now, what do we cover in the 3 days? Well, the first day is all about finding deals. We'll talk about asset managers, creating your list, how to market more effectively to them, giving you examples. There's a ton of stuff in our manual about finding deals and building a database of asset managers and banking and note selling contacts that can send you deals on a regular basis. Okay. Day 2 is about raising money. How do you find those IRA investors? Let's pull some lists. What do you send to them? All the sample forms and things in our manual are there for you to do that we're using. I'll be sharing my letter campaign we have going on, our postcard campaign, our pitch deck, okay? Day 3 is about making money. Taking those exit strategies or taking the list, diving into those lists to find the deals and how to avoid the dud and how to structure those deals and make money with your own money or with other people's money. Now, we're going to do a variety of true real-world case studies throughout this. But it's 3 days of me spending it with me, not a pitch deck or a pitch fest, okay? Yours truly, Dickie Ball may be coming by. We may have another vendor come by, stop by. But we keep these in-person classes pretty intimate. I think we'll probably have around 30 to 40 people at the class here in Austin, Texas, and I guarantee we'll take good care of you. And right now, if you go to notebuyingfordummies.com, we're still running a special, a 30% off special. Oh, so if you sign up for it, it's not going to be $1,500. It drops it to about $1,000. But we do have a special offer for you guys here. You're also, when you sign up for the in-person class, you're going to get replays to the class we taught in October online. You'll also get a ticket to the class upcoming in April that you can take virtually as a refresher for you. No additional cost. We're going to have a 4-week implementation group coaching with that class. So we're going to be focused on them making deals, making offers, getting things in place. We'll be doing that via Zoom after the class. People love that because it's us holding their hands. You also get access to the Laughlin Associates Entity Secrets class that Laughlin's put together. This is really good as an online class. talking about secrets of entities and how to structure things. That's a $99 value on their website. They give it to our students for free. We're going to throw in our wholesaling notes and calling banks master classes. These are 2 different classes, one-day classes that we taught about a year or 2 ago, going through how we wholesale, or going through what you need to do when calling banks and asset managers. We're going to give you also a series on 20 ways to find and fund video note deals. 20 ways to find, 20 ways to fund. This is a training video series. People loved it. So we have that back in there for you. And guess what? Your spouse or partner can come at no additional cost to the class. Okay. And we're going to have an exclusive note pool for our attendees to bid on. Not 10 assets, not junk assets like some other people do. These are going to be a couple of tapes that we get from our sellers that we're going to do a deep dive into. Okay, give them an opportunity to make some offers. We're going to do some due diligence on those files in class to help people take their business next level. Now that's a couple $2,500 or more in bonuses. Real estate, we sell that stuff individually. We're going to throw that into you for you. But literally, nobuyingfordummies.com. It's normally $14.97 for you plus your spouse. That's an in-person workshop. Okay, we're dropping it down 30% today. If you sign up at No Buying for Dummies today, and you're live on here right now. Okay, it is February 1st as I record this. The class is February 14th. You can get 30% off today. But since you hung around with me, I'm going to give you a special offer in just a second. All right. Now we have a monthly membership that's $97 a month. People love this too. They're getting started. They can't afford to come to a class. They can't afford to fly out, but they want to get a little bit extra coaching, a little bit of hand-holding. Then the monthly membership is something that would be beneficial for you. That's $97 per month. You get signed up for that at noteumbrella.com. That gets you access to Basecamp group, which gives you the replay videos. It gives you access to the virtual class, not the in-person class. If you're a WC member, you also get a discount to the in-person class if you want to come. We get vendor discounts to that. You get phone calls with me one-on-one. Once a month with me to help you go through your business, help you structure some things, help you set up some things. That's there to help you kind of hold your hand. That's $97 a month. Minimum is 6 months. If you sign up that for a month, you just can't cancel, take all the classes and learn that and run your merry way. Got to be a 6-month minimum with this. Okay. But $97 a month covers that for you, get you a bigger discount, some things. And we want you to kick ass and take names. So people, after attending the 3-day class, been around for a while, they realize that, hey, I'm here to really help you close deals. I want to be the Cal. I want to be the Phil. I want to be the Catherines. I want to be the Sterlings that are going out and closing deals and making money. And we have our note coaching program available for you. Now, the requirement of the note coaching program is right off the bat, you take the class. You got to learn the nuts and bolts. We credit what you paid towards the class, towards what you paid towards the coaching. Now, what's involved with the coaching? Well, we start you off about 8 to 10 weeks of weekly coaching calls with you and me. Sometimes it's longer, sometimes it's less. Everybody's a little bit different. For an hour to 2 hours a day, helping you with your business. And we can do that in the morning, the afternoons, the evening, what works best around your schedule. I only like to have about 4 or 5 coaching students at a time because I have my own stuff. I have 2 right now. So I've got spot for 3. Okay. But after those 8 weeks of coaching where we get you making offers and marketing for money and breaking down assets and making offers by week 2, all right, we want you closing on deals. So at that first 10-week period, when you're closing on deals, you're getting confidence, you're making more offers, you're understanding the process of marketing. Okay. Now everybody's a little bit, some people need more help in raising the capital in the front end, other need people finding deals. That's why we customize it for what you're going on. It's not somebody else coaching with you, it's me truly live with you on these coaching calls, one-on-one on Zoom, not pre-recorded. It's you and me going through things. After you've gone through that 10-week period, then we have you come out and spend 2 days with me one-on-one here in Austin. We give you, we put you on the list to our 12 hedge fund managers so you can start getting deals sent to you. That's why we have such a high close rate. We're going to give you contact. We're going to put you at the front of the line. There's plenty of deals to go around, ladies and gentlemen. I ain't got to get a list and pick stuff from my own portfolio and then give you the crumbs. That's not the way I work. Okay. You get VIP access to me. We're going to help you with raising private capital. We're going to help you with marketing. We're going to help you with the executive summary. We're going to show you the places to market and post. If you want to go to Magnify Your Wealth, we can get you a ticket to that for free and other things. So worth what we charge for this, ladies and gentlemen. And my biggest thing when somebody signs up for coaching with me is I want you to make your money back as fast as possible. All right. My experience is worth this. If you want to go from 0 to 60 and it takes you 6 years, do that. If you want to do it in 12 years, you can do that by going through and just looking at our coaching calls and YouTube videos, stuff like that. That's fine. But if you really want to go to 0 to 100 miles an hour in 60 days, this is the way to do it. All right. Now, the cost for this is a little bit more expensive. It's got a little bit of investment in it, but we do and are willing to work with payment plans for you. Cost of this is 25 grand. Okay. We usually require a down payment, and we're willing to take the different amount and spread it over 3-4 months. We also, if you ever want to pay in full, we'll give you a discount of 5 grand to drop it down to 20. Remember, we apply what you paid towards our workshop too, towards that amount as well. Okay. If you come to the workshop and realize, well, I want to do it, you've got a 30-day time period for the workshops to still get that paid in full discount and have it apply. Okay. We'll set up monthly payment plans, and we're glad to spread this out over 6 to 12 months for you. If you close on a deal beforehand, we're going to ask that you apply 50% of your profit towards the outstanding balance to pay that off earlier as well. But it's a full year of coaching and beyond. I still take phone calls from coaching students over a year ago to answer their questions on a note deal or a property or something like that, an exit strategy to help out. Heck, I went out and helped Cal take a deed in lieu on a property just recently. Okay. We have a 95% success rate with our coaching students. The 5% that aren't successful are those that never made an offer or were too scared to pull the trigger and just disappeared. Unfortunately, it happens. But if you're with me, we're going to get you to close a deal. We're going to make you making offers. We're going to get you going out marketing. You can't be a secret agent, man or woman, and succeed, but we will help you at that. All right. There is a third party also too. If you don't have the money, if you've got a job, 2 years of work history, you make 40 grand or more a year, and a 620 FICO score or greater, they'll probably carry your financing for you. They'll fund the thing full purchase at 25K and then spread out payments over 24 to 36 months. 500 a month less. There's no payment the first 30 days on this. And some people have taken this to leverage their money, come and get the coaching, close on a first deal, pay off the financing, and be off rocking and rolling. Okay, no prepayment penalty on this. This is through a company called Ease Financial. If you're interested in seeing if you qualify for this, whether it's for the full amount or partial amount, totally fine to do that. You can get it approved in basically a couple hours, not days. And if you go to bit.ly/Scott's Coaching, as it says there, you can see if you qualify for that third-party financing. Okay. We want you to succeed. We've got multiple ways for you to get tapped into our network and our resources to get going. But really the next step for most of you is going to be notebuyingfordummies.com. If you want to join the list of successful students, this is the first stop to get your nuts and bolts in place. You've been through, dip your toes in the water, but if you want to dive in, this is where the water's warm. Come on in. Come join me in Austin, February 14th, 15th, and 16th. It's a Friday, Saturday, Sunday. You want to fly in. If you're fly in Thursday night, so you're here. We start at 9 a.m. on Friday. We'll wrap up Friday about 5, 6 o'clock. Go to dinner as a group. It's Valentine's Day. Come fall in love with notes for us for the weekend, right? Saturday, 9 to 5, 9 to 6. Sunday will be like 9 to 3, okay? We'll take an hour lunch break on Friday, Saturday. Sunday, probably 30 minutes. Probably bring in some food for lunch. We'll cover breakfast for you guys. The evenings will be for networking. But the reason we wrap up at 3 o'clock is I know folks will be heading out to catch your flight. We're only about a 20, 30-minute drive from the airport in Austin, no traffic. Come in, fly out late night, and enjoy 3 days with us and kick some ass and take some names. And like I said, if you sign up for it at notebuyingfordummies.com right now, it'll drop to 30%. But since you're in the chat roll here with me, if you do this, if you go there, you'll see the discount. Go to Note Buying for Dummies, hit the RSVP. It'll take you to a checkout page. It'll say the 30% discount. If you type in this code, since you're live with me here, all right, live with me here, you type in that code, that 5-letter word, all caps, it'll drop it down to even a better price for you, okay? It'll drop it down. I'll just tell you, if you're missing this on the live streams, sucks to be you. Should have joined us over here on Zoom. That'll drop it down to $4.99 per person for you. So if you're coming by yourself, guess what? You don't have to pay $1,000. You can take advantage and get it for $4.99. That's your seat. If you bring another guest, it's $4.99 per person. We know some folks are just coming by themselves. That's fine. So we still drop it down there. You get the replays. You still get all the bonuses sent to you. Ability to sign up for it. If something happens, and here's another thing that we throw in here too. If at the end of day one, Friday afternoon, we wrap at 5. If you don't think that first day has been impactful to your business or getting things, come let me know. Say, hey, Scott, I don't like this. Great. The first hour you think you don't like it. I'd say stick around because you learn stuff. But at the end of day one, I don't like this. It's not for me. Just let me know. We'll refund back your tuition. No questions asked. All right. Now, you can't pay for show up and not attend. That doesn't count. Okay. If you come in and spend a day with me and I haven't helped you see, build a list, help you find, get some deals in, go through some things, make it the most impactful note class you've ever taken, I'll gladly refund your money and let you go have the weekend. All right. That's how powerful and how much we believe we have the best class. Well, we know we have the best class. The proof is in the pudding. But if you want to close notes and dive in the world of non-performing notes, get signed up today. Notebuyingfordummies.com. Take advantage of the discount code. That's all caps. All right. That discount code will be good through Monday, and you'll be ready to rock and roll. And we'll see you in 2 weeks here in Austin, Texas, with yours truly to kick some ass and take some names and go from there. Once again, notebuyingfordummies.com. Day 1, all about finding deals. Day 2, all about raising money and marketing. Day 3, all about making money. It's an intimate class. Like I said, 40 people, probably a little bit less. We might have some more. Who knows? You guys may all sign up for it. But we're here to help you take advantage and make the most of this year and help you answer and solve your questions about why. Why am I here? What do I want to accomplish? What do I want to do? Whether it's your own money or other people's money, come spend Valentine's Day weekend. It may not be 80 degrees here, but the deals will be hot and it'll be warm inside and toasty, and we'll take good care of you. All right. Any questions, any comments before we guys let you go for the day that we've come to? Like I said, right about 1:30. I'm pretty good at this for you. Once again, I'm going to type in that code here. If you go to boom, and enter in the code. At the checkout, there'll be a button that pops up there, shows you the price, discount code. Type that in there, and it'll knock it down and hit apply, give you even cheaper discount for you. Okay, $4.99 per person. Best I could do for you guys on that. I want to thank you for spending time with me here. If there's no any other questions, go ahead and enjoy the rest of your Saturday. Enjoy your Sunday. We'll send this video out, replay, get posted by tomorrow, and restream it again. But go out, take some action, everybody. Thanks, Andrew. Thanks, everybody. And we look forward to seeing you soon here in the next 2 weeks here in Austin, Texas. Heather, Sandra, love to see you guys in person here. Alicia, if you have questions too, feel free to book a call with me. talkwithscottcarson.com. I'm glad I let you pick my brain. 30-minute phone call on my schedule. I'm here to help you guys take your business to the next levels. Okay. Thanks, everybody. We'll see you at the top.